Hola, hola, hola. Hola, 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 hola. Ok, mejor, ok. ¿Se escucha claro? ¿Sí?
I tend to be loud.
Buenas tardes. Hello, hello. Hi, good afternoon. Thank you very much. We are going to begin our afternoon sessions. We have a terrific discussion about 2025. So now let's focus and try to build this bridge to 2030. And our first afternoon session will be a dialogue between Amanda Meato and Pete Lesueur from TradeWeb.
Thank you.
Pete, Amanda, very welcome. Very happy to have you here.
Thank you very much, Antonio. As with the theme being bridges, we wanted to actually, rather than jump right into modernization, we wanted to take a step back for the benefit of everyone in the room and bridge from how we got from the start of electronic trading in U.S. Treasuries to where we are today. TradeWeb was founded in 1997 by a consortium of banks with the sole initial goal of electronifying the U.S. Treasury market that was solely operated and executed via voice trading. So there were a number of inefficiencies, and the simple technology was called an RFQ. One thing everybody has to know about electronic trading is that it's an alphabet soup of acronyms and jumbled letters. So RFQ, request for quote. The idea being it was too inefficient to call your brokers for the best price on a U.S. Treasury instrument. And so TradeWeb started by electronifying that message, sending out the inquiry to 5 dealers, and being able to automatically execute on the best price. Fast forward over 25 years, and we've evolved into the TBA mortgage space, all money market instruments, derivatives, ETFs, and we've really gotten much more complex since then. But I wanted to just at least bridge where for our part of the company, Tradeweb Institutional, we are a platform that sits between the buy side and the sell side. So I think that gives us a decent framework to start with. And then I wanted to hand it over to Amanda, who will talk a little bit about, through all that history, how we have and how the bond market has adapted to that electronification and modernized.
Perfect. Thank you, Pete. So yeah, we're going to keep this kind of nice and conversational. It reminds me of something we just launched at Tradeweb, a podcast that we call Off the Desk. So if you want to check it out, it is streaming on Spotify and everything like that. But really changing the tune over to what does the state of modernization in electronic trading look like? What does that mean for the bond market overall? And I typically like to break it down into 3 key themes. So one is the obvious one, technology. So the platforms everyone's using today to operate. 2 is automation, so automation of your actual trade activity. And 3 has to do with regulation and market structure. So I want to dig a little deeper into point 1, technology. Pete gave us a nice background about Tradeweb and all of the products we trade. Basically, we are a secondary market trading platform for everything in fixed income and equities. There are not that many players in this space, to be quite honest. We compete with about, I would say, 2 major other players. Everyone has a little bit of their strengths and weaknesses across different asset classes, but Tradeweb has a very unique position in that we operate in the client-to-dealer institutional market. We also operate in the interdealer, so broker-to-broker market, and we also have an arm that reaches out to retail investors. So sitting on this side, we are actually able to consume a lot of information and data through the past 23 years of the firm, and wanted to kind of share some of those insights, just industry-wide with you, not just for Tradeweb, but what's happening across the entire electronic space. So when we look at trends of how is e-trading actually progressing? If we're looking at just the last 5 years, starting back in 2019, pre-COVID, I want to take the US credit market as a prime example. So in 2019, the investment grade credit market share for just electronic trading was about 25%. At that point, it had been around, electronic trading for credit had been around for over 20 years, so still only at 25%. With the acceleration of COVID, 2020 hits and continues to stick, all the behaviors we learned and all the efficiencies we created, the marketplace jumped to 50% in 5 years. So if you're looking back from 2019 and the prior 20 years, and it was just creeping up percentage point by percentage point year over year, that was an astounding amount of growth that we saw in just something like US investment grade credit. If we shift to something like US Treasuries, interesting enough, pre-pandemic, 2019, we were at about 40 to 45% electronic share. A lot of conflicting opinions on how people are measuring this in the US Treasury market, but we did see a bit of a pop after COVID, another 5 percentage points of increase, but not as dramatic as US credit. So still trying to figure out, the differences there. The US Treasury market has grown tremendously market volume-wise, so I feel like it's been hard to keep up with how are we going to electronify the pieces of the marketplace that are much larger, like roll transactions, deep off-the-run liquidity, things that just are still heavily voiced. And then kind of our last example I would give you is emerging markets. Much harder to measure as far as like where are we with progress of market share. We have the split between hard currency and local currency, but at Tradeweb, we are a leader in the space primarily in EM swaps. So we're seeing a lot more electronification, but obviously less regulation behind that. So acceleration of electronifying has been a bit slower, I would say. So the second topic of kind of what else is driving modernization, I briefly mentioned automation, and this kind of ties into a lot of AI talk. It's awesome this morning, and I know we're going to hit it in the next panel. But when I say automation of trading, and a lot of people like to use the phrase low-touch trading, means in the most simple form, rules-based trading. So I want to trade a security and go out to 4 dealers in the next 5 minutes, and if I get a price that is at or better than the TradeWeb composite, just auto-execute for me. So that level of rules-based trading, something at TradeWeb we call AIEX, it's basic, right? I think it's been around for over 10 years before all the AI boom has happened. But now we're seeing we're moving into the next phase of automated trading, where we can now bring in data sets for pre-trade analytics. TradeWeb can now suggest dealer selections for you. We can suggest what bond is similar to another bond. Where do we think the price is? We have our own internal data products that essentially have created an AI price in a certain product. So just to give you kind of some context around how much has this grown for low touch or automation of trading, in the US Treasury market, over 60% of the trades on the platform in TradeWeb are happening via this automation tool, which is an astounding stat. You're definitely seeing it happen to smaller trade sizes, whether investors are breaking up their trade sizes to handle that, but it's a massive, massive amount of adoption, and we've seen that truly accelerate in the last 5 years. So speaking on smart decision making, and I know, Pete, you have a lot of insights on something that is touching on AI and dealer selection. Maybe you can kind of expand for the group a little bit more.
Yeah, I think that's one of the topics that's just advanced the pace of change with how much has moved electronic, and we had a great conversation at lunch about this as well. Some of the protocols that we've introduced and that platforms are now bringing to clients are getting smarter and smarter. So I'll kind of save some of that for the automation conversation, but basically being able to work with our clients, review historical data, ingest live pricing streams and axes from dealers, and then also overlay that with additional recommendations that we have on platform data. It's really merging this connection between and bridging the old and the new, where, as you can tell, obviously a tremendous portion of the business has adapted to electronic trading, and now they want to get smarter and smarter and more automated. So we see even in like EM swaps to speak about, this was something that was probably later to adapt, but it came on the heels of developed market swaps trading, where it's found that actually asking for a request for market protocol has been the way of choice. And again, that's like it's capturing the data and it's using the data to be most intelligent about your execution.
Yes, kind of taking your last point. So I was saying I would really sum it up into 3 topics. It's technology, it's automation, and the last one being regulation. So EM swaps, not as much so in that bucket, but the driver of swaps trading essentially on when CEF mandates came into play for US counterparties. So TradeWeb had to create the swap execution facility where there was mandated trading had to happen on the platform. So that push of regulation and market structure truly was an inflection point for the market for swaps trading in general, and we really had a huge opportunity to come in and take that as a whole. So,
if I could just add
yes,
on regulation, like something like it certainly gave our platform in electronic trading a boost overall, especially with the CEF mandate. But I think the point being made was there was definitely resistance early on, some kicking and screaming about why would I have to change from voice to electronic, and then it wasn't more than 6 months to a year into it where many of those same institutions and clients and traders were then saying, what more can I do? And that's a bit of why even something like emerging market swaps, which was not mandated at all, became wow, this is just so incredibly efficient, and I'm so happy with my liquidity and execution that, what more can I do? What more can I do with different currencies and what other protocols?
yeah, and the next big driver, I'm sure a lot of you have seen this SEC news, and maybe this changes obviously with the recent landscape here politically, but US Treasury mandated clearing is coming for broker-dealers in the summer of 2025. So this is going to be a massive, massive overhaul of the industry. It requires a ton of work from the banks and from the vendors like ourselves for the preparation of this. And then we're even looking at 2026 mandatory clearing of repo for everyone, investors and the sell side. So a lot of change coming our way. Still a little bit too early. Like we can obviously talk about the pros and cons of that, but just wanted to put that on your radar of recent news that's very meaningful to us.
I think it brings us to the second question that I have for you. So with the shift to electronic trading, can you speak more about how liquidity has changed? I've touched on it, but can you dive deeper into the benefits with liquidity?
Yeah. I think for the more liquid products, it's kind of been a no-brainer that we've seen over the years tighter bid-ask spreads, right? Great for end investors, sometimes tougher for the banks. But with that, it's created an opportunity for more competition. So we've seen new entrants into the space come in a really meaningful way. Someone like a Citadel Securities, massive player in the US Treasury space. Swaps, they've been a great partner to Tradeweb. You see some of the higher frequency firms coming into this space. So overall, net has been positive for investors to have more market depth and liquidity. Second part of that is really lower transactions costs, right? When we see this, how do we measure that and be able to go back to show your clients where you're saving the money? And that's really where electronic trading can play a huge asset into your pitch. And at Tradeweb and our competing platforms, we have TCA protocols, transaction cost analysis, that can essentially show you all of your trade data, give you the suggestions, and also tell you where, if you were trading something off platform and dump it into our TCA tool, we can show you how much more improvement you would get if you came on the platform and went into competition with 3 versus going out on voice to 1. So it's a real eye-opening experience when someone's willing to kind of go down the TCA route and do an analysis. And then we can also show you what else is going on the platform. So not only with your own top counterparties, but also with other dealers that you may not even be utilizing in your selection. Liquidity being impacted, shift to electronic. I would say another 2 key trends in this space might be familiar to some people in the room. When things become less liquid, we're always looking for ways to build a new protocol to enhance the liquidity. So something that allowed Tradeweb to kind of really get their foot in the door in the credit market, specifically in US credit, something of the origination called portfolio trading. And early days, we decided to make a bet on this type of trading. The dealers didn't even have an actual portfolio trader sitting at the bank. It was a very, very manual process. Spreadsheets going back and forth, multiple people quoting securities. Hours could go into just doing a spreadsheet of 300 securities in one list. And we were able to package that up in an electronic way. And what it's done is now people are utilizing this as a really efficient tool to transfer risk and also include super illiquid securities. Whereas in the past, it had been really hard to transfer maybe this bond on an individual RFQ, to Pete's point. But if the dealer knows they're willing to give you one price on the entire package, take that down, they're getting enhanced best execution. So it's really taken over the space in credit for portfolio trading, and that's just another way that liquidity has been impacted by e-trading. I know we talk about something, you said RFQ, can you tell us a little bit more about RFM?
Yes, so RFM, and I'll speak broadly because it's not available in every market because not every market has called for it, but RFM is basically where a client can request a two-way market so that they're not disclosing which direction they're going. And there's obviously a ton of concern, especially with central banks and large institutions where they tend to have larger trade sizes that might impact the market, which in turn might make a dealer not show you the best price on a large electronic block. We've created RFM in many asset classes in order to not divulge which direction you're going, but still give you the protection so you can't trade on the wrong side. And in many cases, like in emerging markets, that's actually become the preferred method. Clients want to trade that way. Dealers expect to need to quote that way. And the execution's been quite strong. So I think there are other markets. It's interesting, even though EM is later to the game, there's other parts of the market now that want to revert back and say, well, we appreciate that protocol, and we want to have it in our other asset classes as well.
probably have time for one more, I feel like. Watching our timer.
Yeah, I think we're maybe one or two more. Obviously we've spoken a bit about the efficiency of electronic platforms, the liquidity that's improved, and I guess possibly most importantly, and one thing we hear discussed a ton, is how have these electronic markets helped, or how have they reacted during times of market stress?
Yeah, so hate to overuse the COVID examples, but obviously it was such a key change in the industry that changed everyone, right? We never had work from home. We didn't know how to do this and streamline the front office, the middle office, and the back office. But even looking back to what happened on Tradeweb and all the different marketplaces we operate in, COVID was a really interesting time because the resilience of the marketplace, like we were back to normalcy in less than 2 weeks. Definitely was there a liquidity crisis. Yes, we saw a lot of people backing away because we've never seen anything like this in the history of mankind. But from COVID, if you look at the next crisis that happened, like SVB, the collapse of SVB and what happened there, any type of recent Fed action that creates a lot of flurry on a platform or in the market, we've seen the reaction and the stress on the system like get better and better and better year over year. And I would say historically, pre-5 years ago, pre-2019, in times of market stress, we actually saw a lot of people revert back to the phone. People do what they're comfortable. They want to talk to a human. Not that we're here, we are not here to just intermediate. We're here to kind of give you the efficiency play to continue your relationship, but in a faster, more efficient way. So once people got used to that and got over the hump of COVID, it feels like every other big market event, we have not seen people leaving the platform. We don't see that stat anymore. So it's kind of in a moot point. Even with the US election, we were staffed overnight and on all the different offices just to make sure the platform is going to be up and be resilient. And it was a complete non-event. And we learned a lot from it, but we really do believe that electronic trading has been able to enable calmness in times of when there is true real market stress.
Yeah, I think it certainly in those times it helps connect the buy side and the sell side, and then also within each firm, the platforms can connect the data flow from front office to middle and back office, and actually creates quite a bit of security. We just have one more minute here, so I did want to ask you about some risks. So modernization, evolution, what risks would you consider, or do you want to speak about?
I mean, my Tradeweb hat, it's like minimal, right? We say there can't be a lot of risks to electronic trading. It's enhancing your workflow. But I would say, what are the two common kind of pushbacks we get? And I alluded to one was, I don't want to disintermediate my relationships. I want my dealer to know I'm here. I want to be able to have that relationship. We agree. They're both our clients, sell side and the buy side. We agree that we're here to just give you options. So whether you want to do an RFQ, whether you need to ingest streaming data, or you want to do a portfolio trade, or you still need to do that big block trade over the phone, that's completely fine. But that shouldn't really, I guess, be the barrier to at least having a platform to give you the option, to basically give you all the tools in this scenario to make your decisions. So I said, one, disintermediation. Two would be information leakage. People do get nervous about that, but again, it goes back to what are the platforms offering you that give you flexibility for that type of transaction you're trying to do? And for example, like a request for marketed two-way is 100% giving you the protection. You're not going out and blasting the entire market. You can just speak to your one dealer. You can do an RFM to one, essentially, and get that information because you want to capture it in your system and be able to do the analysis off the back end of it later on. So I would say those are the two main risks that we usually fight up against.
Yeah. It's really interesting. And I think we're going to wrap up here because we got to move on to the next panel. Keep on time.
Thank you very much to Amanda and Peter. There will be plenty of time to follow up questions during the panel. Thank you very much. And our next guest is Marie Briere from Amundi. She's the head of investor intelligence and academic partnerships, and she will be talking about artificial intelligence in investment.
Yes, thank you. All right, I'm too loud. Is it all right? Okay. So it's a great pleasure to be here. Thanks a lot for the invitation. All right. So great conference. Congratulations for a great program. And I'm very happy to share with you some insights on the way we can use artificial intelligence for investment. So as you said, I'm part of the research department at Amundi, so I'm going to bring some of the research insights we can get for practical decisions, a practical investment decision, basically. So AI is transforming our economy. I mean, we discussed that already this morning from an economic perspective. I mean, it will bring efficiency gains. It will also probably cut some of the jobs. And of course, for all of us, we know that it will disrupt our jobs because we are already all using large language models for our daily jobs. So what we will do in the next 10 years will be very different from what we were doing in the past. And for investment, that will also very likely have a disruptive impact. So what will be the impact on finance? Of course, I asked ChatGPT to help me answer that question. And ChatGPT gave me quite reasonable answers in 10 points. It's always very organized. So, and then I reorganized it. It's a kind of human-robot interaction. So we collaborated with ChatGPT to get a sensible answer. So the 10 points were: first, data and predictive analysis, algorithmic trading, quant analysis and portfolio management. And then I thought all that is about quantitative investment, right? And then ChatGPT answered customer service and customization, robo-advisors. All that can be classified in customers' relations. And then ChatGPT quoted algorithmic credit scoring, regulatory compliance, fraud detection and security. Also quoted operational efficiency, so that's a broad, I would say, category, more related to back-office operations. And ChatGPT also mentioned some ethical and regulatory challenges, and we probably will come back on that during the panel. But ChatGPT said that AI has the power to revolutionize the financial sector, so I think that's something quite important to have in mind, by improving decision-making, enhancing customer experience, and driving operational efficiencies. So in my talk, I'm going to cover the first two topics, quantitative investment and customers' relations. These are topics where I've been doing research myself, and I'm going to try to show you some examples of direct applications in these different fields, and also try to answer the question, does it bring value? It's not completely obvious that it might in all cases bring value, so I will try to highlight the main value added of using AI in these fields, but also maybe some of the challenges we discovered when doing some of the research. All right, so let's start with the first topic, which is about AI and quantitative investment. So what you can do with AI is incorporate real-time information. And in particular, it's very interesting that you can incorporate unstructured information, right? So there is a bunch of alternative data, we call them alternative data. So typically non-quantitative data in the first place, but which are transformed into quantitative data to be used as signal for investment. So what can you use? You can use text and sound for sure. For example, companies' disclosures, call transcripts, regulatory filings, news from the media, broker research, NGOs information, but it can go even into social media, blogs, podcasts, and I think that's something very important to keep in mind. I mean, these last types of sources are less reliable, probably, also much more prone to manipulation. We'll come back on that probably during the panel in part of the risks that we might face. When using alternative data, some are more or less reliable. Then you can also use images, for sure, and satellite imagery is very promising. I will come back on that, in my view. There is a lot you can grasp from satellite imagery. So in particular, in the climate space, it's very important. There can be some sensor data, etc. So to do that, I mean, you need to use various techniques from web scraping, NLP, speech recognition, computer vision, machine learning. So the idea is to extract this information and transform it in a quantitative data that you can use in an investment process. So let me show you some examples of textual analysis, which I find quite promising. So textual analysis have been really massively improving. So we did some research, and then ChatGPT came, and all what we were doing before was quite obsolete, honestly. But it's worth having that in mind. We started from traditional NLP, like relationship extraction, topic classification, sentiment analysis, and all that can be done very quickly, very efficiently with ChatGPT now, or some of these large language models, which will not only quote ChatGPT, because there are a couple of large language models which are quite interesting to use. So what can you do for investment? You can build sentiment measures. I mean, quant investors, they love sentiment, so they can build sentiment on everything. It can be macroeconomic sentiment, it can be sentiment on a given firm, it can be even climate sentiment. I worked on this myself. I have a field in sustainable finance, so I was interested in how much people are interested in the climate topic. So all that is sentiment, and it has a large impact on asset prices. So financial markets react to sentiment from what they read in the media, from analysts, how the firms communicate. All that is translated in a kind of signal which is reflecting the sentiment about a given topic. But you can do more than sentiment. So in particular, in sustainable finance, you can, for example, identify firms' controversies. I mean, even if you're not doing sustainable finance, it's very important to be aware of ESG controversies, so, because they have a large impact on stock returns. We also have a research paper on that. You can measure the credibility of companies' commitments about the climate. You can detect greenwashing, so there is interesting research on that as well. And some fintechs, companies, are offering this kind of services at scale. I'm quoting here RepRisk, which is about firms' controversies. So they're offering this service, and it's widely used by market participants. Of course, with large language models, you can do that even better, I would say, because large language models allow you to understand contextual meaning, so they understand much better the context of a given sentence or text, and have a much better understanding of it. And they can answer non-trivial questions about finance, but also about non-financial topics, which is very, very important for finance practitioners, because we are not specialists about everything. And for example, I've been working myself on patents data, so climate innovation, so how much do firms innovate on a given topic, how much patents are they issuing? And I don't know if you have tried to read a patent yourself. As a finance professional, you don't understand the word, right? It's too technical for us. But ChatGPT can summarize it in a non-technical terms, and that's also very efficient for you to process this information. So what can you do with large language models? I mean, you can do the same than before, but much more efficiently. So for example, if you want to estimate sentiment, I mean, it's very easy. You prompt ChatGPT, pretend you're a financial expert with a stock recommendation experience, answer yes if it's a good news, and no if it's a bad news or unknown. And with these 2 lines of prompt, you get a sentiment indicator for a given text, being newspaper article or firm's communication or any kind of text you would feed him in. And you can, of course, industrialize this with an API, and then you get a beautiful indicator of sentiment at the firm level, for example. So all that is very quick and very nice to do. Also quite expensive, and maybe we'll discuss that in the panel as well. This morning we're highlighting some of the cost, also in terms of climate cost of large language models, and that's something which, in my view, is very important. I mean, maybe closer to central banks' interest, you can decipher Fed speeches, so central bank speeches. Again, classify it. Is it dovish? Is it hawkish? Mostly dovish, mostly hawkish. I mean, there is nice research going on that. You can estimate things which are very hard to estimate, like Scope 3 emissions. So we don't have reliable data right now on Scope 3 emissions. I mean, there are some attempts to measure it. For example, from the flows of goods and services through these US environmentally extended input-output data sets. So to measure the flows that happen at a company's level and classify this with a large language model into commodity classes. And I mentioned that already, classifying patents, so the types of patents, and then use that, and in particular use a non-technical summary to identify the type of innovations that are produced by a given firm, and then monitor through that, through time, how a firm is positioned in terms of innovation. All right, so that's what I wanted to tell you about textual analysis. The other very important type of data you can analyze are images. And of course, images is quite new to finance, and we were not used to process images for taking investment decisions, but that's something which we are more and more doing. And in particular, with the rise of satellite imagery, and there are a number of fintechs that were created all over the world, which are proposing to build indicators based on satellite imagery. And you can also access this data yourself and build some of these indicators. I mean, satellite imagery is great because, I mean, there is much less risk of manipulation. I mean, you cannot manipulate easily the satellite imagery, contrary to text data, where, I mean, it's quite easy to feed or to do some adversarial attacks on the large language models. So there is a lot you can do again. So you can track economic activity, for example, from parking lots, images. But where I find these kind of innovations very valuable is in the space of climate finance. So typically, you can verify carbon emission of companies, or analyze their impact on the ecosystems around the firm's facilities. So for example, some research is measuring how much firms are engaged in gas flaring, for example, so they're able to detect these kind of activities, measure air pollution caused by forest fires, water quality, deforestation and reforestation around some of the sites of the companies. All that can be done relatively easily with satellite imagery. So the last thing you can do with, I don't want to anticipate too much on your talk, Rob, but is using machine learning for quantitative investment. And you will go much deeper than I will in that particular part, which is, in my view, very important. So you can use machine learning techniques to forecast returns. And of course, that's ideal when you have a large number of predictors and also non-relationships between variables. And with all what I've said before about the rise of alternative data, now we have a lot of variables. I mean, many indicators that we can use as signals to trade. So that's where these kind of techniques become very important to use, because if you want to incorporate all that information, you cannot do that with simple linear regressions, basically. So there is a lot of research going on that. Here I quote a couple of academic papers, but practitioners are also very active in that field. What we learn from this research is that typically the more complex models, they tend to outperform. So I take this picture from a very influential paper by Gu and Kelly, and these are two very famous researchers in the field. They were comparing a battery of machine learning techniques in forecasting stock returns based on hundreds of stock characteristics. And what you can see from this picture is the R-square, and you can see that the neural networks models typically outperform in terms of predictive ability the more simple types of methods. So I will come back on that in a minute. You can not only forecast stock returns, you can also forecast trading costs. And we did some research on that. So, for example, you can model the interdependencies between the trading costs, the stock characteristics, but also the order attributes, for example, the trade side and the size of the trade, and also the order imbalance to forecast what will be the implementation shortfall of a trade. And in that particular research, we were using Bayesian network that also allow you to handle missing data. And that's quite interesting because typically the order imbalance is something that you do not know at the time where you trade. So these kind of models allow you to make forecasts without knowing the actual value of a given variable at the time when you need to make a decision. So I'm not going to go into the detail. We have research papers publicly available if you would like to have a look at that. So does it bring value? So does all what I've shown you so far, I mean, a lot of innovation, new data, new techniques, is it really worth considering that for your investment decisions? So my answer would be mixed. It's yes and no. Yes in some spaces, but sometimes it's a little bit disappointing. So let's have a look at this alternative data boom that I've mentioned before. We had a paper looking, it was not, we were not having access to ChatGPT at the time, but we had a very sophisticated model, textual model that allowed us to decipher what was the tone of the news, but also the time of the news. It was perfectly understanding the tense, etc. So we're very happy with this model. And we're looking if does it bring to performance. If we implement that into investment decision, if you run a back test with this very nice understanding of news article, do you get a profitable investment strategy? And the answer was a bit disappointing in a way. We could measure that the markets were processing the information very efficiently, so there was very high stock market reaction for the indicators that were supposed to be very important, talking about the future. I mean, all that was very rational. Markets were efficient. But when you were trying to trade that, in particular look at the future performance of the stock, it was much more disappointing. So meaning that we were not the only ones to be equipped with this, what we were thinking at the time, advanced tools. I mean, many other market participants were processing this information in the same way, and all that was incorporated into prices. So machine learning forecasts for trading costs, does it bring value? Yes, it can handle missing data. It's quite interesting, but the improvement versus OLS in that specific example is relatively small. I mentioned all these machine learning techniques to forecast stock return. So does it give good performance? Overall, the answer is yes. And it's true that we reproduce the research by Gu and Kelly that I was mentioning before, and it's true that the more complex model outperforms, but there is some instability in which models perform at which time. The good models are not always the same at all times. And you can see this from this plot where we plotted the percentage of the time a given model ranks first, second, and we go up to 15 because we have 15 different types of machine learning models. So experts that are predicting stock return. And as you can see from this picture, there is color everywhere, right? So, I mean, it's true that the neural networks, they tend to outperform. You see more red and orange colors in the first ranking, so they are better than the others. But sometimes they're very bad as well, right? So they're not always outperforming, and there is some instability in which model perform better than the others through time. So they're not perfect as well. In this research, we were proposing to aggregate these different machine learning experts in order to robustify the outputs, and our aggregation that you can see in black is much better. I mean, it's much more on the left in the first ranking, so better to have a lot of models in order to aggregate them. In my last part, I would like to say a few words as well on customers' relationships. This is something where we see a lot of innovation in terms of AI and the use also of large language models. First thing you can do is, of course, robo-advisors. And now we can advise retail investors on the design of their portfolio strategy, but also advise them on how and when they should rebalance their portfolio. To do that, and maybe some of you are users of these types of tools yourself, I mean, you can use a simple, basic robo-advisors. Now we are more and more considering LLMs as well to do that, to profile clients with LLM, and also to notify for services and to basically chat with the clients to understand what are the needs and what kind of recommendation we should give. And there is also a lot of interest into what we call behavioral coaching, meaning tracking your investment decisions through time. So we are monitoring every connection you're making on the platform. When do you trade? When do you follow the advice of the robo? We are tracking all that And one thing we can do is give you a specific advice or detect if you're panicking. So if you're a guy subject to panicking when markets are in the bear market territory, and then we can give you a call or send you an alert to tell you not to panic. So there is a lot you can do on that. Does it bring value? The answer is yes. We did some research on that as well, on robo-advice, and we found that people are making much better decisions when they're advised by a robot than when they're on their own. So typically, they start rebalancing their portfolio, something they were very rarely doing before, because people tend to sleep on their asset allocation when they are managing their own money, and they had a more diversified portfolio of assets. All that brought improved performance, and in particular for the people that had the most financial needs, people unadvised, people with lower assets on the platform had a larger improvement in terms of performance. There are a lot of issues in terms of trust and explainability. We will probably discuss that in the panel as well, and that's very important. I mean, not only for retail investors, I mean, for all of us. I mean, if you're proposed to use an AI to take investment decision, will you trust the AI? Maybe not immediately. It's like with a self-driving car. How to make you trust the system? One way to do that is to offer you the possibility to change the output to control the system. These are things we would be happy to discuss. And of course, this algorithmic complexity can be problematic for people that have lower financial capability, because typically it's correlated also with the digital capabilities. All right, just to conclude, I think, will finance and investment become algorithmic? I think probably partly, and I think we're going in that direction. It's not an easy task because finance has a low signal-to-noise ratio. It's very hard to forecast in finance, much harder than in medicine, for example. To detect cancer on images is easier than to forecast the stock return. I think we should be very conscious about that. It's non-stationary, the equilibrium depends on the participants' behavior, there are small data issues, so a lot of challenges for finance professionals. But we saw also that there are very good things that can happen with AI, improvement in operational efficiency, the incorporation of unstructured data, something we're not doing before, and more efficient customers' relationship. There are things to discuss that we are going to leave for the panel, but the large cost, issues of explainability, the informational advantage will disappear. I mean, it's a race, so you go for more data, but at some point, others are doing that as well, and you always try to get the most advanced new source of data sets. I mean, that's what hedge funds are doing for decades. And of course, issues of trust and manipulation. So I think if there is one keyword to keep in mind is human-robot interaction. In the future, we will be augmented. We will be augmented with an assistant, an AI assistant, and we will have to collaborate. So I think something we should all collectively think about is how to interact with robots, how to best take decisions when you are complemented with robots or artificial intelligence. So I think that's something we can keep for the discussion. Thank you very much, Antonio.
Thank you very much, Marie. And now we will have a deep dive into machine learning in asset management with Rob Leher, Head of Quantitative Equity Research at Northern Trust.
Thank you, sir. So I appreciate Marie's comments here. I think you're going to see some similarities between her positions and ours. I think I'm going to begin by following up on a theme that was established by Robert this morning, and that is one of curiosity. And I think curiosity is just an excellent way to describe our use of AI today. I mean, we've already seen some examples here. Of course, everyone is quite familiar with being able to render images and/or videos, on demand. And I'll say in some critical instances, we've gone beyond curiosity to reliance. And what's the key piece that allows us to make that transition? I think it's trust, right? So we start to use these tools, there's an element of skepticism, then we come to realize that there's some that are reliability, some use cases that are quite reliable. We begin to trust that, and then we develop a reliance on it. And so at the risk of front-running some of my colleagues here, I just want to make sure everyone realizes that these are not hypotheticals anymore. there are absolutely Gen AI or AI-related tools that are being implemented right now and being used within the context of investments. And so I've got a couple toy examples here. The first one is such an example, right? So we have an analyst. She's asking about the recent outlook for Apple. Here's the response. She's developed her workflow around this particular tool, and she has that element of assurance that how that system is responding can be suitably used. And so therefore, as a consequence of this, she no longer has to concern herself with how that model is working. Perhaps she never did, but she just uses it, right? So it's much like we would think about our smartphones or our televisions. We use it, we don't have to worry about the internals. So the next toy example that I have here, I hope we can all kind of agree. Unfortunately, there's still a very good chance today that we're going to get this answer wrong. And if there's one thing that I know about investors, when they lose money, they typically want to know why, all right? As annoying or as aggravating as that may be. And I don't see that changing in the near future. And so what we can say as it pertains to quant strategies, there's a bit of friction here in terms of our adoption of AI, and I think that friction is a good thing. Okay, so I'm going to just kind of refer to quant strategies as those that require, let's say, either no human action or very minimal human interaction. And so what do we do here? So we have our traditional quant strategies, and we have this ML machine, and we've established that we're not quite ready to turn the entire investment decision-making process over to machine learning. And so we're currently in this environment now that I'll call a hybrid environment. We've got our traditional quant strategies, and we want to extend them, enhance them by way of machine learning. And one such quant strategy is known as factor investing. So I apologize for the abrupt segue to what now looks like a really crude product push, but I promise some of this background I think is going to be important context. So I'll try to just keep it to the salient points. So ours is a style factor platform. It's one form of traditional quant investing. For those who may not be familiar, there are basically three broad classifications that the factor investor uses to delineate among investment strategies. We have passive cap-weighted market beta. These typically align one-for-one with your benchmark. So you ask someone to track the benchmark, and that's represented here. Then you have systematic, risk-based, compensated factors in the middle. Those may have, some individuals here may have heard of, say, Fama French. This is typically around the early to mid-90s when style factor investing, I won't say invented, but really became mainly popular. So this is what's represented here, and this is what we do. And then we have this alpha bucket, which essentially represents everything else. This is a vast umbrella, but we typically traditionally think of this as representing manager skill, right? So maybe stock picking, bond picking, or some aspect of market timing. Now, a couple things that I think are interesting here, relevant to our conversation. The first is not only do factor investors view the world this way, but they tend to allocate this way as well. So they run dedicated passive programs to track their benchmarks, they run dedicated factor programs, and they run dedicated alpha programs. Okay, I've got a brief list of characteristics here. It's certainly not exhaustive, but typically what you would think motivate factor investing, and I think the last one is particularly interesting, and it should be obvious now, but if you ask any average factor investor, they're going to tell you these strategies are typified as being simple, transparent, and interpretable. These are precisely the opposite of what we would typically think of when we think of machine learning algorithms. These can be highly complex, and they can be black box. So this represents a challenge, I would say, not only for asset managers, but particularly for factor managers when we're thinking about trying to reconcile, to bring together this old and the new. Now, I am going to go an unexpected route here, and I want to just acknowledge for this group that there's a couple areas that I think we as an industry are coming up short a little bit, and you can do with this information as you will. But the first area where I think we're lacking a little bit of discipline is I see a very strong tendency to turn factor strategies into alpha strategies. So what I mean by this, the way this happens as quant research, I'm inundated with trial data sets, I'm inundated with trial proprietary alpha signals, and I now have the ability to very quickly, across a full suite of models, test anything that's been thrown my way. And so the propensity to data mine or model mine has increased. All right, now these are old considerations. I'm not suggesting that's new, but I'm saying now the ability and the temptation to do so has been elevated. And if I'm being perfectly frank, we're also, as asset managers, responding to some of the demands of the marketplace, right? And we're all very eager, based on what we've seen, to embrace these things. So in the factor context, the reason why this is so important, remember that they allocate, your factor investor is going to allocate separately. And if we're not careful, we're going to use some kind of data set, we're going to use some kind of signal and or some model, which is going to resemble much more like an alpha strategy than a factor strategy, and now we're no longer honoring the mandates that we've been given. So that's the first area where I think we have some work to do. The second would be, simply put, there's a certain amount of window dressing that's going on here, right? So it's not always clear to me, to others, what that incremental benefit is being delivered by the use of a potentially very complex ML algorithm. And again, if I want some transparency or simplicity, I think this is a really important question that all of us need to be transparent about, or at least ask, okay? So, we've developed some very simple guiding principles. I'm going to illustrate this by way of a use case. Before doing so, let's just be clear here. These are not, by any stretch, silver bullets, but definitely it's something that we think these are important disciplines that we should abide by. And if nothing else, it just makes us always cognizant that we are hopefully not falling into these traps, okay? So in the interest of time, I'm just going to skip over the first one. I'm going to go right to the second. Now, there are some technical details in here. They're not important for this conversation, so I'm just going to gloss over them. And if you're really interested or a masochist, I can give you the research report after this. The first use case that we have relates to something called factor momentum. Okay, now momentum is something that we typically associate with companies or at the security level. In fact, many of us refer to it as company sentiment. Okay? There's a big body of evidence that suggests momentum exists everywhere throughout the market, right? Within different types of cohorts, within industries, within networks, and among them within factors as well. And so our investors are increasingly interested as to whether or not we can incorporate factor momentum into their portfolios. Now, there's one challenge, I guess, that's worth noting, and that is we have a bit of a problem in terms of identifying or measuring the individual performance contribution that's coming from each specific factor. So in very, very simple terms, these are not mutually exclusive. I can have a company or a stock that is both high value as well as high quality, as well as low volatility all at one time. And if that stock has a momentum score, let's say perhaps it's performed very, very well, to which of those factors do I attribute this performance? Where's the momentum? Where should I associate it with? And so disentangling these types of relationships is a very high, it's a great strength of these ML models. And I'm guessing if you've seen any of this type of literature, one of the first benefits is that these ML models have the ability to detect and control for very, very complex interaction effects, okay? Now, for the purpose of this use case, we use something called XGBoost. It's a very popular decision tree ensemble. What's, I guess, important here is that it has a very, very flexible functional form, which allows it then to account for these asymmetries as well as interaction effects. And so on the bottom left here, I'm showing you 4 independent factors. When I combine this with something called a Shapley value attribution, it's possible for me to get a full return distribution of the return contribution coming from each individual factor, right? Which is important then, if I want to then in turn use this to inform a factor momentum model. And then on the bottom right, I'm just showing a simple example of how it models these interaction effects. Okay. So this is model number 1 that we've used. For model number 2, we go back to the 70s, and we use something called the Fama-Macbeth regression. Now, if there's any researchers among us, I can almost promise you they've heard of this. This is, I would say, one of the gold standards within the asset pricing literature. At its core, it just uses traditional ordinary least squares regression. So I'm going to measure my factor momentum using this model. In conjunction with my XGBoost model, I have the exact same inputs that I'm supplying to both. I'm asking them to perform the exact same task, but of course they have completely different formulations. So when I do this, I then create a simple rules-based factor momentum strategy, and I compare the results of both techniques. And what we find is that the performance is very, very similar. So adhering to our first principles, we are always going to favor the Fama-Macbeth model for that transparency. It's a tried and true tested econometric model. But then we'll bring in the XGBoost algorithm as a signal strength indicator. So essentially, I'm going to use that OLS model to create a weighting scheme, a tilted weighting scheme. And then when these models are in very strong agreement, I'll just increase those factor momentum bets. This is just one example of how we're approaching this problem. And then I've got some scatter plots here that show how these models can be different, which is a good thing. Again, this is that different formulation. Just for a point of reference, I want to say about 25% of the time we found that these particular models agreed in excess of a 0.5 correlation. Okay, so we somewhat arbitrarily for our research report chose that threshold. But a really nice byproduct of this, I hope, illustrates our approach here, is that I now have the ability to precisely measure the incremental impact of that nonlinear model. All right, this is just one use case, but this is the spirit of what we're trying to do. Just so for the point of comparison, I think that's a yellow line, perhaps it's orange. This represents the Fama-Macbeth framework in isolation. This is simple linear regression. The blue shaded regions then show me when these models are in agreement and how the incremental benefit here. So now I have something that I can quantitatively refer to when I ask myself, the complexity that's being introduced here, perhaps that lack of transparency, is it worth the incremental benefit, or am I guilty of window dressing here, right? Now that decision is most likely still subjective, but at least we have some data points that we can aid in that decision. Okay, so that concludes. One other thing I want to importantly say, because we anchor to that Fama-Macbeth model, then we always have complete transparency into what that model is doing at any point in time, okay? In fact, let me just go back 1 minute. So if I think about our journey then, right, if I can use the bridge analogy, I'm trying not to butcher this, maybe this represents, part of that pathway, if you will, towards that adoption to where everything is ML-based. So just for the purpose of illustrating, I could envision a day in which these relationships, I allowed myself to reverse them. So in other words, as I became to gain more familiarity with our machine learning models, AI, et cetera, as I learned to trust them, as I observed their performance, maybe it's the case that I'd want to anchor to that model because it's superior, and I now believe it to be, and I use that OLS model as a signal strength indicator instead. And then when I've perhaps finally arrived, maybe it's the case that I remove the OLS model altogether and I just use 2 machine learning models. I could see that plausibly as being a scenario perhaps in the distant future. Okay, so this is how we're kind of thinking about this evolution, if you will. There's one other thing I want to make before concluding here, a point I want to make. It's about generative AI, so I feel somewhat obligated to comment on it. But as an industry, we are still very much relying upon historical empirical data sets, right? So it's pretty common when we receive an RFP that we're asked for a backtest simulation, and I'm not trying to suggest that there's anything wrong with that, but that kind of represents the first case for testing these models and/or strategies. So of course, many, many years ago, we've extended beyond this to include things like Monte Carlo simulations, which is perfectly acceptable. These have been great incremental improvements, but I'll say generally, these typically require us to make very strong assumptions about the underlying distributions that are generating these sequences, and maybe I don't want to do that. So one of the things that generative AI allows us to do is to create plausible economic sequences without having to be so prescriptive about those underlying distributions that are generating this. Now, when we think about bringing these things together, we don't think that one is going to supplant the others. We just think this is a perfect complement. So we'll test across all of these different ensembles, if you will, for the spirit of testing. But then I think the next logical extension here, which is already underway, is to use these to inform your risk management as well as your portfolio construction techniques. So that there are some early stage practitioners that are already starting to adopt this. The potential, I think, is really good here. So this is also then how we're thinking about migrating, if you will, right? That maybe represents a stage along the path of the bridge. Okay. I think that's all I want to say at this point. I'll reserve everything else for the panel. I do just want to say that, obviously I represent asset management. Northern Trust is a big enterprise. Within operations, within asset servicing, within our capital markets, there's a lot of other interesting ML use cases going on, particularly in sec lending, also as well as trading. So if that's of interest to anyone, please feel free to tap me on the shoulder and or my colleague, Virgil here. Thank you.
Thank you very much. And now I expect that you're ready to see some magic, a different kind of magic. This is a multi-agent generative investment copilot with Krishna and Adela from SIGTech.
Thank you, everyone. And I am acutely mindful that I am what stands between you and the next coffee break. So although it says there's 30 minutes, I have an ability to be concise yet effective and to the point. Ladies and gentlemen, my name is Krishna Nadella. I'm the Chief Commercial Officer for SIGTech. SIGTech is a 2019 spin-out of Brevin Howard, the global macro hedge fund run out of London by Alan Howard. Our CEO, Bin Ren, was the former Chief Investment Officer at Brevin Howard. So not only is he our founder and our CEO, he himself came from the industry as a former trader and individual from the investment community. SIGTech's flagship product that came out of Brevin Howard is actually a web-based SaaS platform that focuses on the areas of pre-trade portfolio analytics, specifically in the areas of data validation, research, backtesting, portfolio construction, and deployment. Essentially a one-stop shop for newly launched early-stage hedge funds, institutional asset managers, asset owners to get up and running in a very short amount of time. We are cross-asset because we work heavily with the data providers. In fact, we have about 25 to 30 different data partners that we work with, encompassing about 125 to 150 different data sets. Firms like Refinitiv and ICE, to S&P, IHS Markit, all the way to Quandl and CSI. I say this because at the end of the day, regardless of whether it's SaaS or AI, nothing ever will replace data. Data is the oil that runs our industry. Now, with that said, the people that we focus on within our client set are those that drive alpha: CIOs, PMs, research analysts, quants, and traders. The folks that are driving the business, generating returns, and ultimately making the decisions. Now, for our product, it is programmatic. You must know how to code, you must know how to speak in Python, which for most of us in this audience would think that's pretty much in line with the last 20 years. That is how the industry has conducted itself. For those that are looking to build strategies, to run research and backtesting, to construct portfolios, that has been the language du jour. But at SIGTech, we realized there's a much larger audience we can cater to. People with good investment ideas, people who understand the markets, people who have an ability to convey it verbally but may not programmatically. So for us, about a year and a half ago, we disaggregated our product down to the API level. And the reason we did this was we realized if we can start talking via API to large language models, we might be able to start to enter a world where you no longer need to code to be able to do the job function that has been done historically for over 2 decades. So in September of last year, we launched our prototype on ChatGPT's marketplace called SIGTech Finance. And Michelle, if you can share my screen. There you go. SIGTech Finance was launched on the OpenAI marketplace. In all candidness, it's about 55% parity to our flagship product. At the end of the day, we're not a charity, we're here to make money, but this is publicly available, free of charge, to anyone who has ChatGPT. So if you were to actually go online right now, go to the marketplace, you could find it. And to give you a sense of the type of questions we're able to answer, I'll just take one of the pre-canned ones to let you see how it works in action. Did I actually press that? Yeah. So we utilize ChatGPT in the sense that it understands how to ask and interpret the question. But we don't use ChatGPT to answer it. Now you're probably saying, what do you mean by that? Well, this is where the APIs kick in, as I mentioned. And as you can see here, as we're communicating with ChatGPT, it's making API calls back to the SIGTech framework. And you can click on these chevrons, and you can start to get a sense of the underlying API calls that are being made to understand what the request is, what the prompt is, do you understand the proper nomenclature, and do you understand the proper identifiers? And in doing so, it allows for you to have a better sense of control as to where the information's coming from. I think we can all agree when we look at large language models these days, the biggest question is around hallucinations. Where is the data coming from? Who's providing it? And how can I be sure I know what is trustworthy and what isn't? Well, this is exactly the point that we feel at SIGTech is the way of the future. It's using the large language models responsibly and then being able to go back to something a little bit more robust, a little bit more trustworthy to answer the question. So in about 20 seconds, let's see what type of answer we got here. The question was, how would a 60%, 40% basket of rolling S&P and Treasury futures have performed over the last year? So in every single situation, you click on the chevrons, you can see where the information's coming from, and then the output's there. And as you can see here, you can look at some of the type of information we have. Annualized return, annualized volatility, Sharpe ratio, Sortino, max drawdown. You get the idea. You're not going to get this type of information from ChatGPT. That's the whole point. Using large language models in a vacuum with no other context puts you at the risk of the World Wide Web, the Reddits of the world, and the nefarious websites that make you have to question whether or not that data is reliable, let alone the analytics behind it. For us, we not only have the tabular format, but we have the graphical format as well. And so this was a great point for us when we launched the ChatGPT plugin a year ago, that we could do this on a much more mass scale. So although this is not something we focus on day to day, it's free of charge and anyone can use it, we realized we can actually enter a world of agents, AI agents, this being just one of many of them. And to Antonio's point, we launched in September this year our formal AI investment analyst called Magic, Multi-Agent Generative Investment Copilots. And yes, we worked backwards to make sure it stood for Magic, so in case you're wondering. So moving forward, we now live in a world where that agent you just saw on the previous screen is just one of many that we now have here at Magic. So ladies and gentlemen, welcome to Magic. Magic is a series of AI agents, as I mentioned. And those AI agents can range in all sorts of capacities, roles, and specialties. We have workflow agents, like our compliance agent here that looks, and it's a little hard to read, retrieves trading restriction information. We have specific banking agents, like our Fed analyst here, along with its sister agents, the Bank of Japan, the Bank of England, and the European Central Bank. We have role-specific agents, like the SIGTech CFA, which I think this one's a kind of a neat one. Our CEO took all the publicly available questions from the CFA level 1, 2, and 3 exams and fine-tuned the LLMs to answer them correctly. It's currently at a 95% accuracy rate. We hope to get close to 100% by the end of Q1, beginning of Q2. We have the SIGTech Quant. This is your code builder. Now, who here, by show of hands, knows how to code? I don't. All right, we got a couple. Honestly, is code something you enjoy doing? And if it is, more power to you. But it's time-consuming. It's exhausting. You're looking for the minute details to make sure it's actually correct and the cadence is perfect to get what you want. This now allows you to be assisted to actually review the code versus having to build the code. And then, of course, our SIGTech Copilot, which is like the research analyst, taking documentation, understanding it, and then putting it together in a cohesive fashion. Oh, and you're probably seeing something saying the internet browser. Let's get to that. We are not saying the internet's not a place that you can go to for information. Rest assured, there are very good sites. Our internet browser is a controlled internet browser, so you know exactly which websites you're going to. Fox Business, CNBC, We Don't Judge, CNN, BBC, Washington Post, New York Times. The idea is not that we should be afraid of the internet. The idea is that you should know where the information's coming from. And that's why it's so important in these early days of AI that, first and foremost, you have an understanding that you can challenge anything. You should challenge everything. And that's the whole point at the end of the day. No one should be taking anything at face value. You should have the right to say, where's that data coming from? And you know what? I don't necessarily agree with it. Change the website that you used. Let's look at the data behind that. Where did you get that strategy from? So let's put this to work. As they say, a picture's worth 1,000 words, a demo's worth 1,000 pictures. So I'm going to take an example that I would consider a somewhat broad-based prompt. And when I say prompt, I mean prompt engineering. The idea that it's going to have some detail, but not a tremendous amount. So for me, I like to look at the futures market. And so I'm going to pull up a new prompt here. All right, and I'm going to ask Magic, and I always like to be polite, please compare the performance of cocoa futures. First, I should learn how to spell. To year to date, to gold and oil futures. And please provide the output in tabular format. Pretty self-explanatory, pretty simple, right? That's nothing crazy. I didn't change the world or do rocket science. But this is something you would see a research analyst try to perform, get in on a Monday morning, want to know how the market's doing. So first and foremost, what you don't see, but you see right there, is there's a planner agent inside Magic. That planner agent's now deciding which of these agents I have up here are going to be used. Because it's a bit of a broad-based prompt, it has to determine which agents to go to. And as you can see here, those agents are the SigTech Quant and the Macrobond Economist. Ah, I did not mention Macrobond. Hey, raise some hands. Who knows who Macrobond is? All right, a couple folks. Macrobond is a third-party data provider that works in time series exchange data and macroeconomic data. Effectively, a competitor to Haver, if you've ever heard of Haver. They're well known in the industry. They are a partner of ours. They commissioned us to create an AI agent specifically for their data, so you could use it when you ask these prompts where appropriate. So the world of data agents are also something that's now becoming more and more commonplace. Now, we use these large language models to ask the question, but we don't use them to answer them. As I said, we do the API call. So if you look at what we have here, each and every one of these actions has the underlying code that's there. And that code can be taken and copied downstream into your own system. If you are programmatic, you can challenge it. The gentleman here who is saying he kind of likes code, like you could go challenge that if you wanted to. I think he left now. So the idea is you are not working with a black box. You are working with context and information that you allow you to know where the information is coming from. But you might say, well, Krishna, I understand that's the SigTech framework. Well, it works for the Macromon data as well. You see very clearly that we have the underlying API call code, and you know exactly where it's coming from. The idea, again, is you can challenge anything at any time. And in less time that it took for me to explain how that worked, we already have our output. So let's take a look at that. So, all right, here, give me 1 second. Thankfully, all right, here we go. So, bear with me here. All right. So it's a little hard to see, but if you've been following the cocoa futures market, it's been killing it this year. And so compared to gold and oil, they're doing well as well. But as you can see here, the type of information we're providing, annualized return, Sharpe ratio, Sortino, kurtosis, skewness, return on over the last day, over the last 5 days, over the last 20 days. The idea is you can get this level of granularity, and piggybacking off of what Rob was presenting, we can go much deeper now. We can allow for individuals who are doing this type of work that takes hours, if not days, to now do it in a matter of minutes, if not seconds. The idea is that you're now able to advance and elevate your performance, and in doing so, also allow you to start thinking about the more strategic level work that you do that allows you to derive alpha, think of strategies, and continue to differentiate from your peers in the industry. Now, I do want to be a little cheeky because Rob did ask the question in his presentation, what is the outlook for Apple? So I went ahead and actually asked Magic that question while he was doing his presentation. And you can see here, and again, it's a little hard to read, but generally speaking, you get your recent analyst report and sentiment, the general sentiment, the financial health, the innovations and product releases, the challenges and risks, and the investment recommendations. And then right after that, you get your financial performance, and then the overall graphical output. So again, this is not necessarily saying that anyone's job is going to be replaced. Absolutely not. And we'll talk about more about that on the panel. But what it's saying is you can get a lot more done in a shorter amount of time when you responsibly use large language models to allow you to take away some of that menial task work that you do on a day-to-day basis so you can spend more time focusing on the idea generation that derives alpha at the end of the day. Now, part of my presentation today, on behalf of my CEO and company, is for anyone that would like a free trial of Magic for the remainder of the year, we are happy to provide them to everyone in this room today. All we need is your first name, last name, and email address. And if you have internet access control issues within your company, we're happy to work with you. But we are also mindful that the bigger size of a firm you are, the bigger those issues are. But Magic is completely available for anyone who'd like to trial it. We've had about 250 users already come on board since we launched in September, almost 100 institutions, and we just want to continue to make it available so everyone can do their job in a much more efficient and expeditious fashion. I'll take a second and stop there, unless there's any questions, but I also know that we have a break and we also have a panel discussion afterwards. Thank you.
Thank you very much, Krishna. Well, now we have a 30-minute coffee break, and then we will come back to the last panel of the afternoon. Thank you very much. Hello. Okay. Good afternoon, everyone. Uh, Welcome to our panel discussion on extending the bridge towards 2030. I am Antonio Candia, the Principal of Financial Innovation here at FLAR. And for today's sessions, first I would like to thank all of you for joining us here in beautiful Cartagena. We have an exciting lineup of experts who will share their insight on these transformative technologies shaping the future of finance. And before we begin, I would like to encourage everyone to participate actively. We will be using a Mentimeter, the tool for live polling. And I would like first to gather your thoughts. So please have your devices ready. So this is our first questions. Which of these disruptive technologies do you believe will have the most transformative impact on financial markets by 2030? And if you remember, 1 week ago, we had this fantastic session with David Joseph, who made a great overview of how all these general purpose technologies, other kind of GPTs, are impacting the industry and our lives. Okay, let's give it like 1 more minute. And I suppose I think that the big winner is generative AI. Probably we are biased of what we have seen after seeing Magic. And also followed by machine learning, quantum technology, blockchain, and other. Who answered other? I would like to know what we are missing. What other technology are you referring to? No?
The real question is why you put other in name.
Maybe it was LEO, low orbit, these satellite technologies, or the new space race. So, okay, as we see, like the big winners are generative AI and AI and machine learning. Maybe the two coins of the same thing. So please, the next question. So, does your institution currently have an AI strategy in place? Wow, excellent. So, you know, we are starting to see like more that institutions have an in-development AI strategy. And before we begin to deep dive with related questions on AI, and remembering the geopolitics session when they start with what keeps you up at night, I think it will be great to start with a kind of a similar question, but what's keep getting out of bed to all of you all these years? Because one thing is being worried and scared of what it's coming, but the other thing is that we have, and all of you have been actively working towards the future of our industry. So, Amanda, let's start with.
So, okay, what keeps me up at night in this?
No, what keeps you up at night? What keeps you out of bed?
Out of bed?
All this, yes.
Yes. Yeah, I would say I've always been on the platform side. So electronic trading has been my entire career path, different asset classes, different firms in the space. And why I like it so much is because it's different every day. And the change is quick, even though we like to use this saying a lot. My CEO at the firm, Billy Holt, says, change is slow until it's not. And I think that's kind of spot on, right? You add the days up and you think that behaviors, getting to speak to all different clients all over the world, it feels slow sometimes when you're in it. And like a lot of my job, my team's job is to help change behavior, help embrace efficiencies and technologies. And, that was really hard 15, 20 years ago. It's getting less hard. But now it's kind of shifting to this whole new dynamic, the topics you just had on the polls. So that kind of keeps me motivated to go, like, what else are we going to learn? Today, this was so invigorating for me, just seeing the technologies and the deep dives that the other panelists were giving us. I was like, this is so cool. Like, my mind started flowing. What can we do at TradeWeb? Like, can we link in with some of the information we saw today and make our platform better? So I think it's just the constant change and velocity of new things and never being stale.
Krishna? So I look at my career in terms of 3 stages. I started off at a bank in sales and trading. I moved to a major megatech, Bloomberg, and spent 10 years there on the data side. I then spent time at a late-stage startup, Symphony Communications. And I had a little bit of FinServ at Citi, FinTech, startup life, and it kind of all led me to SigTech. Now, SigTech is a pre-Series A startup. So it is bare bones. It is watching the P&L, being mindful of the runway, and running all the time. But the reason I came is because I think, like everyone on this panel, you want to be doing things that are relevant. You want to feel like not only are you contributing, but you're learning at the same time. Candidly, as a man in his mid-40s, getting a chance to play with large language models, to build AI agents, and then in a very practical way apply them to the very workflow I used to spend my career immersed in, and be able to sit on a panel like this today and talk about some of these topics, that's what gets me up every day. The intellectual growth, the ability to actually have a real, meaningful impact, and to be able to ride this wave in a way that I might not get another chance, along with many of us, to be there at the beginning and see something that we can all really grow and benefit from. So for me, it's a combination of those things, and the understanding that you can never get comfortable, you can never get complacent. You should always try to find ways to get out of your comfort zone. And I posted this on LinkedIn the other day because a lot of people ask me, what's it like to work at an early stage startup? I said, it's professional fulfillment in a constant state of discomfort. And I think that perfectly epitomizes what every day is like, because you're doing things that really make you feel like you're making a difference, but you're always realizing there's more that you can do and you can never get comfortable. So that's kind of what gets me up in the morning to go out and face the world professionally.
Yes, so I think what makes me enthusiastic about these technologies right now is their potential. And I came here with curiosity first on what they can achieve, and I think I'm impressed by what these technologies can achieve, and I think all of us are impressed right now by the generative AI technology. I think it becomes very salient for every one of us. And also, I think it can really bring the best, but probably also the worst, and I think that's something we should discuss maybe later in the panel. The best of finance to the end investors, because I think we are all here as an industry to serve the final investor, and that's what my motivation comes from, is to bring finance, financial tools, softwares, platforms, robo-advisors to the end client, to the end investors, in order to take the right investment decision. Some of you are managing pension assets or sovereign assets, and all that is for the people's benefits. And I think this is what should motivate us. So have all these tools as a way to empower people with their money, give them the possibility to take the right decision. And we are just vectors of that change. That's the way I view technology and our role in the industry.
Thank you. Yeah, so at the risk of sounding cliche, I think it's still absolutely the case that by and large we're financial statement driven, and a lot of the quant signals that we're using today, that in conjunction with kind of like your classic market variables. And so this is really truly, in my career, I think we're really at the cusp of something that is very revolutionary. And has the potential to be disruptive, so I guess that gets me up for a few different reasons, right? But then there's just so much still ahead of us, and in particular, what some of the common critiques that we all are very familiar with, again, this lack of maybe interpretability. Well, there's a lot of progress being made on that front, and then as it pertains to causal inference, I think that's really at the forefront here, and so there's really some exciting technologies, and just to briefly describe, it's one thing to say that two variables are related, but it's something entirely different to say that this variable is actually causing this variable to act in the way that it is. And so really exciting things in front of us. Obviously, big challenges, to be overcome, but we're definitely, this is a new paradigm that we're entering, and then we're not going back.
And I would like to come back to that, because during Marie's presentation, some slides really catch my attention, and she mentioned that, well, for forecasting is difficult, in finance is different. We have been seeing this evolution, like from, it's not the same doing like statistics, that's why we have econometrics as another field. And one thing is doing like machine learning, and totally different thing is doing financial machine learning. Could you expand on this, because you were mentioned that all the problems that we face with the time series that we work with?
Yes, so I mean, one of the challenges in finance is the instability and regime shifts. I mean, we've been dealing with that with the traditional econometric techniques. Causality is one of the challenges, and I will later elaborate on that. Finding what is the causal relationship is key. And in economics, in academic literature, it became a very big challenge. But another big challenge is regime changes in finance. The fact that we are not completely sure that we are in the same regime and there is market instability, and maybe we switch to another regime where other variables might be relevant. So it's an open question if machine learning techniques can allow to detect regime changes better than traditional techniques or not. In a way, I would say that marginally, not only on the technique themselves, but if we look at the paradigm shift that we have been experiencing, not only with machine learning, but also with alternative data sets, is probably a larger focus on the short term. First, because these models, they can adapt very flexibly to short term, and sometimes over-adapt, over-adjust. So might be, of course, good if there are regime changes, but sometimes they overfit in a way, and also the fact that they are using a lot of variables allow them to overfit even more. So I think that's the first thing. Another thing that we should keep in mind is that all these alternative data sets that I was describing during my presentation, most of them have a short history. I mean, you cannot have 30 years of satellite imagery data or all these fancy textual data that we were discussing. So that all leads the industry to focus on the short run, I think. And I think we should be very, very careful on that, because, I mean, you are managing long-term assets. We should be aware about these long-term relationships as well. And sometimes also these data sets can be biased, and we only have information on a particular subset, a particular region, a particular time period. And that sometimes do not allow us to get the full picture. So I think that some of the concerns we need to have when using these kind of techniques or alternative data sets.
Rob, building on that, your work focuses on integrating all anew, enhancing traditional quant strategies with AI and machine learning. How do you see this convergence shaping the investment landscape in the next years?
Yeah, so this is a topic of hot debate, I think, is how quickly we're going to converge, not only in terms of our signals, but the processing of those signals and putting them within the context of a portfolio. I will say it's obvious that there is a new class of alpha signals that are becoming mainstream today. The hedge funds, of course, are using those, and I'm generally referring to things like the Gen AI or the NLP types of data sets. But I'm sure many are familiar with nowcasting models and these kinds of things. And so I think it's reasonable to think that within the next 5 years, there'll be a whole new class of these types of signals that are more or less, similar to one another. Again, going back to the factor space because it's familiar to me, but in the same way that, certain existing momentum signals or valuation metrics, et cetera, they're all different, but they're all kind of similar. And so I definitely see some convergence around this new class of alpha signals, but what's difficult for me to ascertain is that we're all going to consume these in the same manner, that we're all going to combine them in the similar way, and that we'll all put them in the context of our portfolio exactly the same way. So I think we're a ways off from doing that. That I think isn't in the intermediate future, but definitely a new class of signals is here. Yeah.
Yes, and I'd like to jump on that because, that's something we hear a lot. I'm part of some regulatory discussions at ESMA in Europe, for example, and that is an argument we hear a lot, that these models will be very correlated. So first, it's not yet true, as you say, and another thing is that a lot of the previous models we were using could be also very correlated. Look at target date funds, for example, in the pension space. The signals are also, and the strategies that they implement are also very correlated. There is an academic paper which is proving that it has impact on prices because all these target date funds, they rebalance exactly at the same time, and it can have a huge impact on financial markets. In that kind of example, because it's more like a rebalancing strategy, there is no market destabilization that comes with that. But any kind of strategy, we could argue that if they are widely used by the industry, they might become, they might have an impact and potentially a destabilizing impact, but not necessarily, because some strategies, even if everyone uses that, the target date fund example is a very good example, can be stabilizing because people buy when the market has been going down and they sell when the market has been going up. So the fact that there might be market destabilization because of the higher usage of these algorithms, I think it's something that should be debated. It's a very important question, but as you said, we are not there yet, and even if they were widely used, they might also be stabilizing. It depends on the strategy that will be used.
Usually the people that would have to sign off those of these models in the real world are not either capable of understanding them, or if they are, they do not have the time to go in detail on how they work. How do you combine these people of in the real world?
So I think it starts with education and familiarity. Like anything, the things we're scared of the most are the things we don't know. Maybe that's a little too broad-based, but I like to speak in hyperbole. But anytime you look at any sort of technology that's being adopted or implemented, you have to take the time to understand it first and foremost. And so there's a responsibility on the individuals to upskill. And so we were having this conversation at lunch today about who ultimately is responsible for being the one that stays ahead of the game, who stays on top of the new technology, and that understands how to implement it. My argument would be it's on the individual who's in that role because they have a responsibility to do whatever is necessary to continue to advance the role so they can continuously do more for their firm. That seems very high-level, kumbaya-like, but it's true. We all have an accountability to those that we work with and to those that we serve. But if you don't take the time to learn that technology, if you don't take the time to understand how it's being implemented, if you don't take the time to understand how it can have efficacies across workflow, across automation, then you are actually failing. You're failing your constituents, you're failing your customers, and you're failing your colleagues. And so it has to be one where if there's desire to learn, if there's a desire to get out of your comfort zone, if you don't know because you're not necessarily skilled, that's not a crime. But if you don't have a desire to do something about it, I think that is. And so take the time, ask the right questions, go to the right people. If there's no one within your firm, Find the people externally that you can bring in to get you up to speed. It's incumbent on all of us because it is very much a Darwinian attitude in terms of survival of the fittest for what we do. When you think about capital markets and you think about financial services. And so you owe it to your customers, you owe it to the people that are counting on you to take advantage of the technology available responsibly to give the best and maximum output for the returns that you're providing.
I can add on to that. And I was speaking to some people last night at the cocktails, and they were asking me about, how do we feel about human, being replaced, or how secure can you feel in this? And our experience on the execution side when it comes to AI and the first kind of phase that we're at right now and enhancing that and using that for trade execution, the people who are doing it today, the automation, the ingesting of the AI price, maybe they're not using it as Bible yet and they have their own metrics and they should do that in phase one, but the traders who've always been the first ones to adopt and enhance, for example, electronic trading, have always been the most successful, the most profitable, had the longest lifeline. I've seen it. I've covered the same group of clients for 18 years, and it's true. And it's true in every new technology that we see in the next marketplace. So I do believe that you have to embrace it and for the better, and it's going to make you better as an individual.
Yeah. I mean, go ahead.
No, I just wanted to mention that I fully agree. But at the same time, many of these technologies are costly, and I think we should be careful on that the large players, they have the possibility to use that, to deploy it. The smaller one, less so. So there is also an issue of market concentration, that maybe there will be some discrepancies between the market participants, with those having the possibility to use them, deploy it at scale, and those that will not be able to do so. So I don't know what's your perspective on that.
I agree with the point that not all players are the same size and not all players have the same budgets. I completely agree with you on that. But that doesn't mean we can't all understand something that's publicly available to learn about. And so you may not be ready to implement a strategy. You may be one of those folks that were in the poll that says they don't have an AI strategy, but there is no excuse why you should not be learning about AI. You should not be trying to understand how these models are constructed. You're not trying to get access to the free software that is available. So you can come to the table and have something intelligent to say and be able to get the rest of the folks within your firm to also engage in that dialogue because you're all smarter for it, you're all more knowledgeable. And when the budget does come or the approval does or you reallocate funds to something else, you can all sit here at the same time and speak on the same language. That allows you to make a very responsible decision. There's no excuse not to be educated, absolutely none. I will not take any other argument. I'm happy to be opposed to that, but education is free and we should be able to take advantage of it.
From the polling, we see that generative AI was what were people as perceiving with the most transformative power. So this is a question for all of you. How do you see generative AI transforming the buy side and sell side of financial institutions?
I can start from my perspective, not that I am an AI expert, but on the kind of secondary market and what we see. There's something to be said about being the biggest. It has blessings and curses, right? We see it all the time. I see a wide range of what technology is at some of the biggest asset managers in the world to the smallest, most technologically savvy hedge fund. And even today, in 2024, there is a massive gap between. This goes for even all the global banks. It's surprising to see how all over the curve everyone still is today. But I do think the most impactful piece we're going to see on the buy side are those who are kind of taking it in a phased approach. So not necessarily being scared of it, to the earlier point. I mean, I made the joke at lunch. I asked for access at work to ChatGPT, and they were like, no, why do you need it? And I work for a tech firm. Now, this was about a year ago. We just started rolling it out probably 6 months ago, and the conversation has changed dramatically at our firm. So just shows you that I'm sure a lot of you sitting here today would have the same answer if your firm's not ready yet, that they're not going to give you that access. So I think the firms that will succeed are the ones that will educate themselves, approach it in phases, learn and refine, because everything is moving so fast. There's no way to kind of have it figured out as we've seen all today.
For us, we work heavily with the buy side. And like most new technologies, it's all risk-reward. If the reward outweighs the risk, they're going to find an edge to be able to implement the technology. But at the end of the day, it's also a copycat league. And that if someone's using something that's giving them an edge, forget across the buy side, within one firm, if one pod has access to something, the other pod's going to say, what are you using? And we have a couple buy-side shops that are using Magic right now, but it's only for a few select pods. And invariably what's happening now are people within the same firm going, why does that guy have Magic, and why don't we, and how do we get access? And that's showing the true value because they're getting something out of it that's allowing them to perform better. And so my point in saying that is, if you are someone that's in a position where you have to drive value, you have to, make alpha, and you are being judged, and it's very ruthless and cutthroat, like the buy side, like a hedge fund, then you're going to dive probably a lot faster into this. If you're a larger institution, you have a fiduciary responsibility to do right by your constituents, but you also have a lot of, precautionary measures in place, then you probably are going to tap the brakes a little bit more. And there's nothing wrong with that. What it just says is that you're probably not going to be the first mover, but when you move, you're going to move very thoughtfully, and you're probably going to have a lot less risk by that point. Whereas the smaller, more agile firms are going to take on that risk, but because if they can hit that target, the returns are very large. The analogy I always use is, anyone here, just show of hands, who has a Tesla? All right. No one in Latin America has a Tesla. Okay, thank you. And for those that have a Tesla, which I think is 2 people, who has the self-driving capability in their Tesla? All right, now it's down to 1 person. Oh, 2 people, okay. And who uses the self-driving capability every day? I don't know what that means. Not really reliable. So the risk-reward of giving up control of the driving capability in a Tesla, you're not ready to do yet. You're not ready to fall asleep, read a newspaper, watch a video while you're driving back and forth from the supermarket or from work. You're not there yet. It's the same thing with generative AI in financial services. We're all at various levels of risk-reward. Are we ready to make that plunge and give up some of that control? That's the same analogy. So we're all kind of still in, we want to grab the handle, we want to be in the driver's seat, and we want to make sure we get to control when we press the gas and when we press the brake. That's what we're going through right now as a society. That's what we're going through now as an industry. And that will continue to progress until one day our esteemed colleague over here will decide to say, you know what, I don't want to drive anymore. I'm tired, it's late, I want to just be able to rest and close my eyes and get home and know I'll get there safely. At some point down the road, we're all going to, as an industry, say, generative AI has a very real place in our workflow and very important and meaningful workflow operations that actually have real consequences if it doesn't get it right, whether it be getting home safely or whether putting a lot of zeros at the end of that number to be able to bet and execute on a strategy.
Yes, I agree that. I think control is a very good way to give trust in the technology. And I think it's good that we as humans keep control at some point. Even if AI improves and we can fully delegate, I think it can also very easily be manipulated by other humans. So I think that it's very important that we keep regular control on the tools we are using. But coming back to your question, Antonio, on what are the main use cases of generative AI, I think the first is the one you were showing, Krishna. I mean, research assistant. I mean, being an investment manager, being a financial analyst or researcher, you need to have these kind of tools available. And I think you made a great demonstration that having access to this kind of tools saves time. It also, and it has been demonstrated, reduces the gap between the best financial analysts and the worst financial analysts. So we will be more on an equal side. So I think all the discrepancies in capabilities, coding tools, etc., will probably reduce in the future. So then there will be some probably consequences on wages as well, because why paying a lot to guide if complemented with an AI, someone less competent can do the same. So I think that's something we should think about. So the first research assistant, I see that deploying really at scale. And the second one is really this interaction with the end investors, I mean, the retail client. I think there is huge potential for that because a lot of people do not get access to financial advice right now. I mean, and there are a lot of questions about the quality of the advice that people receive. So if you do not have a very high wealth, you typically get not such a good advice. A biased advice as well. It has been shown, for example, that women or young people, they are less asked about their financial situation, so they get less personalized advice. So I think on that, Gen AI can be a wonderful tool to automatize the relationship with the clients and give financial advice at scale to people that basically get no access to this kind of tools and information. So it can be really great. We should also be very, very careful on that because I mentioned that there is a huge scope of manipulation. Right now, there is fascinating research on the way we can use large language model to profile people. So based on you answering a few questions, I can tell you who you are. I mean, you know, Facebook was already doing that by tracking all what we were posting on the platform. Now we can ask you to answer a few questions and get a profiling done by the large language model and assign you a portfolio, for example. So that is not implemented at scale. It's more research done on that field. But I think we should also be very careful with these kind of technologies. It's also very easy to manipulate, I mean, to feed you with information that will make you take a given decision. I mean, there is research on political voting, for example, and how it can be manipulated by Gen AI. So all these tools, I mean, not only in the financial sector, they are also, you know, very, very powerful in terms of their potential for manipulation. So I think it's really great for improvement, but we should really carefully monitor the way they are used, who controls them, and how they are used by people in practice.
Yeah, so not much incrementally to add. I'll just say I didn't want to misrepresent things. There's still a lot of productivity gains to be had within firms like ours. There's no question about it. And so we're a quant shop. Code is really still, I mean, that's foundational to us. And so as the code accelerators become better, I mean, those are real productivity gains for us. And then there's still a lot of legacy code that's out there. There's still a lot of code that we share with the academic community. So the ability to port these types of things, we're still a ways from being able to just accept it at face value. So we still need, it's very important that we have people who are smart enough to be able to go in and debug where necessary and make sure that they're, that it got it correct. But that's an area it's really, it's fruitful still in terms of productivity. But then let me just also say, I'll take a different angle here. With respect to coming back to investments, we all like to talk about the alpha side, but when you think about things like feature selection, again, risk management, portfolio construction, there's as much opportunity to deploy these types of models within that context. And it can actually, I would argue, very reasonably, I think, that you could actually add some stability to markets. So we all talk about, oh, there's a signal that every single model is going to pick up on. We're all going to try to buy or sell at the same time. That could very well be the case. But then on the flip side, we can add robustness, right, to our regime indicators, to our risk models, these types of things. And so I think we should consider that as well. And we kind of might think about stepping our way up the value stack, right? And in doing so, we'll be able to apply our learnings within areas that maybe that risk-reward is more reasonable or more acceptable, again, before we're ready to kind of turn all of the keys over. That's kind of how I see this, evolving.
I am pretty sure that Iker has a lot of questions, so...
Ask in general first, I guess. I certainly do have lots of questions.
Any questions? Yes, go ahead, Marcelo.
Yeah. How big of a risk do you see of unregulated AI?
Yes, I can elaborate a little bit on that. So I think it's a very good question. How much should we regulate the use of AI? And I guess different countries have different stance on that. So I think it's just the beginning. In Europe, we have the AI Act, and Europe is pretty much into regulation, while the US is more like on well, let's try and test it and see how it goes, and more on the market type of evolution. So my personal view, but maybe I'm biased as a European, is that we should regulate, because we should be very careful on where power might concentrate. And by listening to you, I was thinking, when listening on what we are developing, that the market power might displace. I mean, it was pretty much with data providers. I mean, as a user, as Amundi, we're using a lot of data, and we're always struggling to negotiate costs and prices, etc. And you probably are facing the same issues. And I'm now thinking, why paying a license to an external data provider now that we have these platforms that are going to intermediate the relationship? It's like with Netflix or with Deezer. Why buying music? I mean, you can just pay on demand. So why would I buy all the MSCI data if I only need 2 years of data for a particular index? So you might probably gain much more market power in the future as a platform intermediating the use of data. So that's why maybe you should be regulated from a European point of view, because you will probably concentrate a lot of this power. And that's very important that, in my view, we know how you use the data, how you make it available, that there is no bias in the way you present it, because that's certainly crucial.
I'll add to, so the word I wouldn't use is necessarily regulate, but responsible. This is the wild, wild west right now. These are the early days. And we were talking about the crypto market as well. Like, we're all trying to get our handle on it. And like most good ideas, and full disclosure, I used to structure and syndicate collateralized debt obligations and collateralized loan obligations. That was a good idea at one point. And then 2008 happened. And now we have CLO 2.0, we have CLO 3.0. And you could go back to the junk bond market with Michael Milken back in the 80s, and now it's a natural part of the portfolio diversification. My point in saying this is, we don't know what's going to come yet, but I think we can all agree the human condition is to take a good idea and run it into the ground every single time until some controls are put in place. So how responsible we are now before those controls are put in place will have a lot of bearing of how the higher powers that be step in or not in terms of allowing this technology to permeate within our professional and personal workflow. But I would also say it's all incumbent on us. This goes back to the upskilling and the education. If we are ignorant to what this can do in a positive or negative sense, then we only have ourselves to blame when it starts to be controlled and handcuffed in terms of where we can and where we cannot use it. And that is the human condition. And I'm happy to have a larger conversation over drinks tonight, but we can never seem to let things work in a way that benefits as many as possible. We have a tendency as human beings to try to take something and run it and run it and run it. And so we have this chance now to do it differently, where we can take this technology, which encompasses more than capital markets, more than financial services, more than corporate. It's all-encompassing. And so how do we take it upon ourselves to be all individually responsible of how it's being applied, how it's being used, and having a voice that speaks in unison to where we should and we should not use it?
Iker?
Yeah, well, that's a good segue to my question, Krishna. So when Antonio put that question in the beginning, the word cloud, not the word cloud, what's the technology you see having most impact in the financial market in the remaining of the decade? I was like, do I really have to choose one? How do I do that? I mean, you have blockchain, you have quantum, generative, machine learning, and so on. And it reminds me of that movie. I don't know who has watched it. It's called Everything, Everywhere, All at Once. And that's a theme that we were speaking this morning. Each of these individual technologies are transformative enough on their own and impossible to predict, but all of them coming at once. It's just unreal task to go through. So Antonio, in our conversations, has an expression. He says that we are living in the prehistoric times of something big. So in 100 or 200 years from now, people will be looking at this point in time and seeing all the seeds of all that is happening. So maybe with that context in mind, and you are all, quite, acquainted with all these elements. What would be your view of things to come, say, 5-10 years from now, tokenized assets, quantum computing, AI in levels that we cannot even foresee? So I know it's a hard exercise, but I know that it is coming and we have to make our best effort. So I know it's a tough question, but I'll throw it over to you.
Maybe I would like to compliment and start with Amanda, because we have been talking about that there is a lot of work to do, like in financial infrastructure and integrating all of this regarding digital assets and tokenization. So what are your thoughts? And I know that there's been some headlines regarding TradeWeb.
So when you put that question up, for whatever reason, my mind went to blockchain, because we were talking about this, my colleagues, all week, and I'm just like, the more I learn and the more we apply it, like early days blockchain to me was like Bitcoin, cryptocurrency, right? Now I shifted to more of what's happening in markets in my world here, and thinking about blockchain and digital assets for every financial instrument. Like, how insane will that be when and if it all goes that way? And I was thinking, like, that could be 5 years away. It could, which is crazy to really think about in practice, and what would be necessary for all industry participants to be prepared for something like that. And obviously at TradeWeb, we have a group under the chief product officer that basically spends all of his time outside of our core businesses. And tokenization, digital assets is one of them. And all the big banks, of course, have very serious constructs within there, like operating and figuring out how they want to do this, or some of them are even ready to go, and they're waiting on regulators. So recent headlines earlier this week, we're doing small little investments with strategic partners in the marketplace, and we just announced a partnership with Goldman Sachs. Goldman Sachs has their own digital asset blockchain platform called GSDApp. So basically, we partnered with them for they will handle all the technology of tokenizing financial instruments, and essentially TradeWeb wants to be, or will be, the marketplace for transacting and settlement. So really be the secondary marketplace for something like that. And we haven't even talked about it in the broader group, like within my firm, right? We had this kind of leadership talk just about 2 weeks ago, and they were finally sharing more of these strategies with us. And now my mind keeps racing, thinking about like how close we could be to that if some regulation comes in, especially with who we're going to have in office now. We know how they feel about cryptocurrency, blockchain. So could it go that way a lot quicker than anybody thinks? I think it's a real possibility. Yeah.
Thank you.
I love the movie reference, by the way. That was a great movie. So, it's a lot. It's a lot, and I'm not even remotely qualified to talk about cryptocurrency. I mean, I have friends who have some, and that's the closest I've ever gotten. But it goes back to the point I said earlier. Like, you don't need to pick a lane, but you should try to at least get a little bit more educated. You should at least have a better sense of what's going on, because I don't want to, again, I do like speaking hyperbole, but I don't want to think that there's ever a time where there's so much happening at one time more than this time right now. And what a great time to be in this space, to be in this world, because all of these things have the potential to be transformative. And so getting into it, learning it, becoming knowledgeable about it gives you that empowerment to then make the right decisions and then capitalize on them, or at least be in the thick of it. You know, Michael J. Fox of Back to the Future fame says, all you need is a chip and a chair to have a chance. Well, this is everyone's chance. You know, educate yourself. understand how it affects your own personal life. Then how does it affect your professional life? And then if it doesn't, it doesn't. And you know. And that's half the battle. But if you don't, that's just ignorance, and there's no one to blame but yourself. But if it's too much, pick a lane, run down that lane, don't jog, don't walk, run, because I can assure you everyone else is running. And it's not a good place to be when everyone has the exact same information for the most part as you do. So that's the opportunity to do something really meaningful. For me, I've chosen the Gen AI path. That is a professional choice I made to join an early stage startup and really learn about this technology in a meaningful way. And in the year and a half I've been at SigTech, I can tell you the gentleman that entered the doors in May of 2023 could not speak outside of ChatGPT and asking really dumb questions that my son asked me to put into the system about SpongeBob SquarePants, to now working with Grok, Mixtral, Llama, Cloud, Azure OpenAI, ChatGPT, understanding which ones are the better models, how do you optimize, and then being able to construct agents, and what's involved in constructing an agent, and how do you get multi-agents to work together. That's a year and a half. So it's not impossible. We're not in a position where we can't find ourselves becoming experts in a short amount of time, but you have to do the work, and you have to figure out what's important to you. I'll stop there.
Yeah, so it's a great question, very, very important one. And it's interesting that you mentioned blockchain, because the ideology behind blockchain at the start by the founders, I mean, I think the way it's used now, it's completely different. I mean, this idea and this ideology of disintermediation, that we would give finance for the people, I mean, it's not there at all. I mean, apart from certain cryptocurrencies, now the way blockchain is used is by Goldman Sachs, the big banks, etc. So I think this idea of a complete disruption, then where we would not have these big players being banks, so I think that will not happen. At least that's what we see. So the question for me, the important one, is who will be the key players? And I'm not sure these will be banks in the future. I mean, if you look at other sectors, I mean, these platforms, these intermediaries, they are going to play a very, very big role in the future. So I think that's what's very interesting with the technology, apart from what you can do. And I think it's very easy for us to grasp what we can do with the technology concretely, how we can improve the services. I mean, that's the first step of understanding of the impact of the technology. The broader implications of who will be the key players, who will have market power, that's something we should really think about. And my view is that the platforms will get stronger power in the future, and we should certainly monitor that and maybe regulate it, coming back to the previous question.
Rob,
yeah, so maybe just hopefully it's within the spirit of the question, but you know, there's clearly a trend towards democratization of these algorithms, right, and data also as well, so the cloud computing, these types of things. You know, our technology stack, a lot of it's open source right now. You know, this is all great. I have heard the opinion, and I think there's some merit to it, that maybe one of the unintentional consequences here is that these things could be misused a bit from some individuals who don't maybe fully grasp what it is, you know, that these tools are capable of. And so, very simply put, you know, again, as we go back to like these really powerful AI types of use cases right now, there's a lot of individuals now that have just built a tremendous amount of confidence around, you know, these abilities, and so, you know, there's a bit of trepidation that do they understand that when you're applying it in this setting, it may not necessarily be the same as applying it in another, and so, you know, will there be that moment or two where we have some painful lessons that are learned that might represent some setbacks in terms of our adoption? I think it's reasonable to think. It's hard to forecast what that might be. This might not be just a linear progression, I guess is what I'm trying to say. So on one hand, you know, you've got you know, we want everything to be democratic. At the other hand, you know, I don't know that it's necessarily our place, but you want to maybe protect individuals from themselves.
That's a good point in terms of the non-linearity of it all. I think we have to remember that if you look at all the major, you know, real significant points in mankind, the industrial age, the electronic age, and whatever we're going to call this age, the AI age or the crypto age, there's the first movers who dive in headfirst and take advantage, and maybe there's some setbacks and they learn from them, but they keep pushing forward. Then there's the middle of that bell curve that comes along because they're able to see it more refined, the technology. They see the benefits that provide it to them, but then they also dip their toe slowly into the technology. And then there's the leftovers, the spillovers, who begrudgingly go in because their existing options are taken away from them because no one wants to see you riding a horse down the highway. They want to see you in a car. No one wants to be seeing you read, paper newspapers because we all want you to be reading on a tablet, and so on and so on and so on. And so understanding that this will take time, and the time aspect we're all still determining, that's, I think, important to keep in context that when we say implementing technology, when we say, looking at how this affects, workflow and integration, that's still to be determined. And it's not going to be a quick hockey stick until it is.
Yes, Diego, go ahead.
No, thank you. Just wanted to get the panel's thoughts on where are you seeing the most underinvestment in the adoption of these new technologies? I mean, is it knowledge training? Is it the tools itself? Is it having the infrastructure to run them? Like, what would be your thoughts on where the underinvestment is for the adoption of these technologies?
So, go.
I think one part of underinvestment could honestly be more on like a cybersecurity side, that people are really scared. Like, I'm thinking how that conversation at my own firm. Okay, no, you can't just go access the regular public chat GPT in our own network. 2, you're going to put in proprietary information from our firm. So obviously, when you engage in a more commercial license with these players, there's ways to contain that in a wrapper that you have security of your information. So I think that is probably one of the biggest hurdles from someone going from 0 to step 1, any firm, because they're really nervous about, like, where is their information? Where is the data going to go? And susceptible to any type of cyber risk. So I think that's kind of a big piece.
I'm going to go big on this question because I feel very passionate about this answer. So when I started my career, I was told there's 2 types of roles you can have. You can be a revenue generator, or you can be a cost center. Sorry, it's just as black and white as that. You're either making money for your company, or you're spending the company's money. We can all get on board with that, as unfair as that might sound. I still think there's a huge underinvestment on the cost center side. Look, at the end of the day, generating revenue, you can put a number to your name, you can say how many dollars you brought in, and you can show how you're growing the company's P&L. On the cost center side, there is so much inefficiency that still exists in 2024. And the one I like to pick on the most is loan settlement in the United States. It's at T plus 40 now? Like, is that not absurd? T plus 40 to settle a loan? It used to be T plus 30. We went the wrong way. Like, explain that to me. After COVID, when everyone can close a home, like, online, like, and I say this somewhat in jest and somewhat tongue-in-cheek, but, like, we got to start doing better. And I'm sorry, if there are players in place who are preventing that efficiency from happening, that's a professional crime of some sort. And so my point is not to say eliminate jobs. I am not saying that. But if the workflow itself is so godly inefficient, then something has to be done to eliminate that, because it has a ripple effect everywhere else. And so I actually would say double down on the support centers, on the cost centers, because then you're going to allow for people to do more strategic level work. You're going to allow the opportunity to use more of your mind in terms of what you do every day versus the manual aspects of a job that should be eliminated, so you can do better, so you can upskill and go back to my original point and thesis. But we don't see that. We see little tinkerings on the side. But when things like loan settlement still exists in 2024, we are sadly failing. And so we only have ourselves to look at and ask the question, why haven't we figured this out yet?
Yeah, it's hard to give numbers on that question. So it's a great question, but very, very difficult to ask, to answer. I would agree on cybersecurity, and I would add to that, because that's the feedback I received. We organized recently a closed-door discussion with ESMA, so the European regulator, and also the Turing Institute, on the use of large language models within financial institutions. One of the feedback we received from about 50 participants that were using these kind of technologies or being in a position where they should use it is the lack of training that you mentioned. So a lot of people mentioned that they would love, or that their colleagues would love to be trained on large language models. So people are basically trying by themselves. It's probably a big operational risk at some point. So I think we should massively invest in getting more training on how we should interact with these kind of technologies at the global level. And I think there is underinvestment here, for sure, at least at the feedback we got from European financial institutions.
So I'm a bit outside of my domain here, but being in quant research, it means that I'm perennially at war with our IT department. And so it's very, very easy for me to pick on them. But I think it would be a bit misplaced if I were to say, the adoption of these tools is the underutilization or the underinvestment right now, because I do think that, as we are all probably very aware, there are some regulatory hurdles that have to be considered. And so I made the comment before, and I think this is where we were coming from when they asked around unregulated AI. Well, it's not the model itself, I don't think, that we're talking about, but these models are trained on the data, and so then that's really the question is, who owns the data? Do we have a right to train our models on this data? Are we going to expose ourselves to a number of different legal considerations, et cetera? And so, I mean, I'll wait to withhold my judgment once we receive some clarity here, then, and remove that hurdle, which I think is very understandable. It's a very viable hurdle. Once that's been removed, then I think we can look at ourselves and blame ourselves for not, utilizing these tools enough. But I have to give, there's some credence there to that concern. I think we have some wood to chop there, from what I understand. Yeah.
Please, Marco, go ahead.
Thanks, Antonio. One major concern that I have is inequality. I think Robert mentioned in his presentation this morning about inequality, social inequality, I imagine. That's what you were. But I'm also concerned about inequality between institutions, right? So we have a lot of official institutions in the room. The question is, probably we'll see also that in the sense that more sophisticated institutions with better training are able to adopt these tools, while others do not. So, and probably the effect can actually be magnified because of the speed of change. So I don't know what your thoughts are regarding on how to make this more equal in terms of access and development.
Marie, do you want to
No,
start?
I fully agree on that. That's something I mentioned. I mean, there will be concentration happening. I mean, that already took place. I mean, there is concentration without generative AI, but that would probably accelerate because of the cost. Look, you cannot develop that yourself. You need to use it, and it's super costly. So if you want to deploy it, so then your question is more tricky because you're asking how can we reduce these inequalities? I mean, that's very tricky. I don't know if there is a good way to reduce these inequalities. Maybe you have better ideas.
It's a combination of both parties, the institution and the individual. If you're self-aware enough to say, I want to learn more, I want to leverage this technology, I want a competitive edge, then it forces you to ask yourself first, what are you doing about it? Assuming you're doing everything you can, then what is your institution? If the institution is not making strides, it could be because they don't know how, they haven't thought it through, there's ignorance, but those all can be overcome with education. But if it's just a choice not to, maybe it's a conservative approach, a fear, a mandate that's coming from up on high, then it goes back to you as the individual to say, is that the type of firm you want to be at? Because I was at my previous firm, I did not see the opportunity to get into the AI space there, and so I made the concerted decision to leave, to go to a place where it's much smaller. I took a significant pay cut, but I knew I was investing myself for the long term. And that's not everyone's opportunity presenting themselves. to that because everyone has to decide that. But there has to be accountability to say what's important to you and then decide what to do once you know what's important to the firm. I wish I could give a more United Nations answer, but unfortunately the world doesn't work that way.
You have something to add?
It's really hard. I wish I knew. I'm thinking about this a lot. I think it kind of goes back to if you don't have the access, what can you do outside of the confines of your firm, and how can you further educate or just influence internally? And any kind of information you could share to benchmark versus what other people are doing, I find always be impactful in any type of enhancement or bring on technology, because we still see it today in our business in very basic forms of technology. Somebody who doesn't want to utilize an API because they just aren't going to go down that path of an investment. So it's a tough one. I'm not quite sure. It's just kind of more down to the individual and how much can you influence outside of your firm.
Now, I will say, a big bank has a lot more runway than a startup. So you're probably good in terms of job viability, and you can take the time to be patient and work with your firm and see what the outlook is long term. We just don't have that luxury at a firm like ours. And we have to make those decisions in a very real-time capacity, because it could be the difference between being here next year and the being here 3 years from now.
Iker, we mentioned that I had this idea that we are in like the prehistoric age of something. Now, after that, I saw agents and magic in action. I have to rethink this, and I think we are in the amoeba phase of agents. And Marie was talking about augmentation, that we are going to collaborate, expand our capabilities with this. But also, as you mentioned, there is a point when this is and can go exponential. And there is this concept of the technological singularity and AGI. And I don't want to get very philosophical on that, more than focus on the augmentation part. Because if you see these sites of bets as Polymarket, of things like that, they are truly people betting that we are going to be surpassed by these technologies in our capacities by 2030. So what will be your thoughts on that, Maria, and especially on how we can augment our capabilities?
So I think we see with these tools, and I think you made a great demonstration, that we can be much more efficient, right? I mean, these were things, all what you show is something we could do, I mean, all of us, but it would take time, right? And we would need a lot of energy to do things which are relatively basic, like plotting the graph, recovering the data, etc. So these efficiency gains, I think, are very important. The question is, and I think that's very obvious, that we will be augmented in that. So when I say augmented, it's not that we are not able to do that. We were able to do that, but then we can do it very quickly and we save time. Then the question is, we save time for what? What remains for humans if we are no longer doing that? And it's interesting because over lunch we were discussing that the creativity process is that remains to humans, but are we all creative? I mean, I think it's an open question. Are we all able to have such a creativity? I'm not so sure. I mean, there are times we are not creative and times we are creative. I mean, as a researcher, you know that. I mean, you are not always at your best, having one idea per minute. I mean, sometimes you are not creative. So I think that's a big challenge as well, or value added as humans, right? Because a lot of what we were doing mechanically, processing information, aggregating it, giving a clever answer to something, is something ChatGPT can do better than we do often. So we need to have this little twist, even for research ideas. I mean, I have some colleagues at the university in the US, so they try to aggregate, to ask ChatGPT to process all the recent literature, and then give research idea. What will be the 10 next best research questions going forward? And they were impressed by the answer because there were a couple of things they were not thinking about. So even for creativity, we might be challenged as well, I think. So yes, are we going to supervise this artificial intelligence? Or we really need to think about our complementarities and how we can really interact with them in a good way, while keeping interest in what we're doing as well, right? Because I think we love the work we are doing so far. Are we going to love the work we do with an AI? So far, it's very exciting, I guess, that you have this impression as well. You have like these assistants sitting close to you, doing all the boring things you didn't like doing, like plotting these graphs. It's a lot of fun, but at some point, we will start to struggle probably in your value added. But people have very different stakes on that, because we can also consider that we are going to collaborate, and we should think about efficient way to collaborate with AI, like in a team. I mean, in a team, we are all equal. We might have, some of us have ideas at certain times, and there are good ways to collaborate together. We could think about collaborative mode with AI as well. It's a great question. It's a science fiction question.
We still need the humans to prompt, right? We'll need to prompt. That's like,
Yeah. I mean, I'll say this much. Einstein said it best: imagination is more important than knowledge. Anything you saw with magic, that was just knowledge that was fine-tuned to a large language model. You still have to have the ability to ask those questions. And what we'll probably see is more of a development across society of critical thinking skills, of creativity and prompt engineering, where we start to think outside the box more. Candidly, how many of us in this room, be honest, how many of you in this room, and I'll put my hand up too, think outside the box at work 5 days a week? Right? It's because the job itself doesn't necessarily ask you to do that. Maybe 2 days out of the week, maybe a few moments here and there where you have a moment of greatness, but the question is, are you even being put in a position where you need to think outside the box, where you need to think outside of the preset norms that everyone says, well, that's how we do it, so we're going to continue to do it that way, or that's how it was done, or that's what senior management said. But what if now we're all forced to have to think outside the box? We're all forced to have to think critically. So it doesn't matter if you're the CEO or you're the junior analyst. It's incumbent on all of us to have to start thinking that way. We're going to start to have to develop that part of our brain in a much more real way. And it's not just in the academic arena, it's going to be in the professional arena as well.
From Frank Kelly insights and coming back to the morning session about geopolitics, one thing that resonates with me is like demographics is destiny. And we are seeing all these things that could derive in an infinite supply of knowledge workers.
Yeah. Listen, if you can be surrounded by knowledge every day, academic institutions are only a pit stop on the lifelong path of learning. And so we should all get into that mindset that we're always learning, we're always students, and we can always improve, regardless of experience, time, age. And that will allow us to stay at the forefront of a lot of this technology and how we leverage it. And so it continues to put us in a position of control versus at the position of having the control being taken away from us.
Yes. And another important point that it is a key to our institution is think about the future of work. And like a recap of what we have been talking about this, not only AI or other technologies like readiness, and then I think all come up to upskilling and reskilling. Can everyone comment what your institutions are doing to upskill and reskill your teams?
Upskilling, or younger generation training, so massive. We were talking about this at lunch. The people coming in, post-college graduates who were in college during COVID had a very different experience than everybody in this room and the rest of their academic training career. Definitely think we're seeing that in the workforce. You see the headlines all the time. Gen Z, they don't want to do this, they don't want to do that. I'm not even going to hate on Gen Z. I think Gen Z can be quite genius. Like, we need to embrace that and figure out how to pivot. So something we do at TradeWeb, which I find quite unique, is we have a talent program group for basically the analyst levels. And they're the top performing analysts. So basically the managers nominate them to be in this top program. And they get to go into this networking group for the calendar year. And they're like the mini think tank of the next generation. And our CEO is really big on, he always says, ideas and relationships. Ideas and relationships. And I feel like that's a really cool opportunity to give young and analyst employees. It doesn't mean they have to hit a home run with every single idea, but one, you're giving them, the space to do it. You're hearing them out so they get the opportunity to present to upper management. And some of the ideas are great. Honestly, I was in a meeting just a few months ago with our help desk, essentially, the analysts, where there's tons of manual workflows, tons of errors happen still on this side. Debbie knows what I'm talking about. And a 6-month employee, 6 months out of school, showed me this script she ran in ChatGPT, and she taught it how to do the setup. We have literally hundreds of preferences and authorizations to get set up on TradeWeb, and she automated the whole thing. And it was like revolutionary. The person who was running that desk for 20 years is, can you believe this? Can you look at Emily? I'm like, no, I can't. And why did it take us so long to get here? And it wasn't like this is so crazy, but we never started embracing that until just this past year. So I feel like we at least are trying to give more of a runway for the next generation to not only for us to teach them, for them to teach us and keep that going. And then the same thing goes for skilled employees. Like, this conversation is even uncomfortable for me. I'm not an expert in this, and we're constantly learning about speaking about this digital asset thing. So trying to keep a pulse on everything that's moving so closely when it's not necessarily in your everyday job is a lot, but that's on me, to your point, to keep that up. So it's an interesting time to be, in a point in your career where you want to keep either moving forward or kind of doing the same thing.
I love the ideas and relationships concept because I never thought of it that way, but we're much smaller. I mean, we're 50 people globally, so each person's like 2% of the company. But everyone within the firm has magic, and they're encouraged to use it. They're encouraged to use it in their workflow, so whether you're an engineer, a product manager, you're in the commercial org, you're in the finance department, or our finance department's one person, you're general counsel, whatever it may be, everyone uses the product. So their ideas, they actually they're developing that ability to ask good prompts, thinking outside of the box and working with this technology. So we want to cultivate that. We don't want to just have this product out there for our customers. We want to use it and use it in a very meaningful way, so that way we're not just trying to solicit something because of a technology. We're actually seeing benefits for us internally. So that's the first thing on the idea side. In the relationship side, I cannot emphasize how important that will always be, regardless of what age we're in, what environment we're in, what technology we're leveraging. My entire career is because of relationships and those who know me and those I know, and how we've been able to stay in touch in a meaningful way. And so for us, it's a small thing, but we're 4 days a week in the office. It's probably not the standard in some places, but I can only do so much on a Zoom call with my junior employees. I can only act with immediacy if I'm in New York City and I want to meet with someone in person. So coming into the office, spending time before a call, after a call, talking about things that were happening in the company that I can explain or just brainstorm. That's building relationships internally. And then being able to role model when we go see a prospective customer, when we go see a prospective partner, and talking with them, and having them come to our office, as small and as modest as it may be, or going to theirs, and showing the value of being in 3 dimensions, not 2. And so ideas and relationships, I'm going to steal that from Billy, but going to say that's just a phenomenal way of looking at the future of work, because I think those two things will never go away.
So I like the idea of link between relationships, and that's also what I'm experiencing and that we are experiencing in our organization, but I'm wondering how long that will last. Because, I mean, if you think about new technologies, I mean, young generation typically embrace the new technologies, they learn it at school, they're better, that's typical. But the difference with this new technology that the Gen AI is going to replace their additional skills very fast. Look at machine learning. I mean, you hire a new guy doing machine learning. Before, 10 years ago, this guy would have value added for a long time. Now, an old guy with an LLM can very easily, I mean, easily, maybe I'm joking, but relatively easily make a machine learning model and use it. So what's the value added of the young generation going forward? I'm maybe a little bit more skeptical. Right now, you're right, they're making this bridge, but in the future, the AI might replace that.
But if I just may, but that all depends on whether or not you see a future where we're not really working together anymore. And we're working all individually at home, in our home offices, and we really don't need to come together.
Yes, you're completely right. I think we should really think about this teamwork, right? And how we collaborate between generations, between AI and humans, and that's super important. Yeah. I agree with you.
Yeah, so I mean, I'll just say as a matter of survival, I think you're seeing this upscaling and rescaling right now. So, you know, in the quant research world, this has traditionally been kind of a top-heavy space. Some would say the price of admission tends to be kind of high. And in the past, there was, I mean, it's always been a little bit blurry, but there's always been these delineations, perhaps because there are individuals who are motivated, you know, to keep them in place between like say your data analytics or your computer science related types of skills, and then you know your traditional quant, so that you know that theory and that math. Well, I think it's very clear that those lines are just completely blurred now, and it's certainly the case that you know if you're a quant analyst, then that also means that you have to be part data scientist. That also means that you have to be very good at like your traditional comp sci skills. And so, again, as a matter of survival, you have to place value across that entire chain. It's no longer the case that we can say, well, these individuals, you know, they're only part of, they're only going to get these benefits. They're only going to have this kind of access to better improve themselves and what have you. So it definitely, it really does truly cut across, you know, age groups now. And certainly across, you know, geography, certainly across socioeconomic status. More than ever, we're putting a lot less emphasis on those ivory tower types of degrees and things like now, because it doesn't benefit us to do that. If you have, you know, quant data science skills, and you have the aptitude and the wherewithal to come into a team and share, then that's what we collectively have to survive. So yeah, it goes beyond, it's a matter. These things are being pushed on us right now, which I mean, whether it's good or bad, I think that's reality.
Thank you. I think Victoria has a question.
Hi, I do now actually have a question. So a rather well-known tech entrepreneur told our annual meeting a couple of weeks ago the following, and I'm quoting directly because I wrote it down, was ChatGPT is trained in a dangerous nihilistic extinctionist far-left philosophy from San Francisco and has an extinctionist risk for humanity. That's clearly hyperbole, but do any of you have a concern about the way that some of these LLMs and generative AIs are trained and the effect that that might have on financial markets as you implement these more? And I think you know who that probably is, but I'm just kind of thinking as we, particularly Christian, and as you are using ChatGPT, does that concern you in any way that you need to think about some of these issues around the training and the data that is used on training some of these LLMs?
Yeah, it does. We work with all the majority of the large language models, and inherent bias is already accepted. Like, not that we condone it, but like we accept that that's being whoever's training large language models is going to be the one that's going to put a bias in there, consciously or not. So the most important thing for us is when we fine-tune them, we do not train large language models, we fine-tune them. We have to bake that into the fact that when we use ChatGPT versus Azure OpenAI versus Llama versus Cloud, we have to spend a lot of time building those agents to the best of our ability to objectively look at those models. And maybe just to take a second to explain how we build an AI agent. It's a combination of things. First and foremost, you have to fine-tune the large language models for financial models. That's a pretty objective thing to do because it's somewhat black and white. You then have to incorporate time series and third-party data. Again, somewhat black and white because this is data sets from the major players that we work with. Third, you have to embed the portfolio analytics, the code base, and the framework, which is our flagship product. Still black and white. Fourth, when a single agent has multiple tasks, you have to make sure it does it in the right order. A little bit of bias now. What's the order that it conducts its tasks? Then you do a multi-agent platform like ours. They all have to work together and talk to each other, and they have to be able to then put together a cohesive response. Therein lies the rub, because depending on what each agent's using from an LLM standpoint and what each agent's constructed to do, that is the part we ourselves acknowledge we do not have control over. We try to do as much as we can at the sourcing point of embedding and encasing all that data and framework, but the agents themselves, there is a part we do not have control over, and so we can only iterate and iterate and iterate, and when new variations of LLMs come out, we try to take the best of that, but we are not going to sit here in any way on the record and say we've eliminated that. We absolutely have not.
Yes, I would add that I fully agree on what you said. I think we need to have a process to deal with these questions. So there is already evidence that there are biases, depending on the corpus they are trained. The problem is that we do not have any transparency on the information that has been used in the first place. So I think that's a big issue, and we will never have transparency. That's another thing we need to accept. So it's completely different from other machine learning techniques where we can request, I mean, there are possibilities to get explainable, and you were showing these very nice plots before where you can have explainable models. Here it's impossible. So I think we need to deal with that. There are also issues that these large language models do not perform the same way in different languages, for example. That also leads to inequalities. So I think we need to deal with this. There are people using large language models, for example, to test other large language models, which means that we need competition. We need to have various providers in order to compete between, and that's also what you're doing with your different agents. So, but right now, I think we need to have more processes on how we should deal with that. And I think it's a very important question going forward.
I would also go as far as to say, this is not the first time in mankind we've had this. If you watch Walt Disney's Snow White, you have a certain interpretation of how that story ends. The evil queen falls off a cliff, Boulder kills her. But if you read the original version of Snow White, she does not die. In fact, she comes back, and she tries to undermine Snow White several other times until she's forced to dance on very hot lava or stones to her death. My point in saying that is, knowing that we have a tendency, whether it be a fairy tale of a book that's written by a certain individual with a certain skew on it or not, we are always going to be using platforms. We are always going to be using technology that has some sort of skew. But so long as we're eyes wide open and as aware as we can be, we go in knowing that, and then the risk reward says, do we still use it? I was at Disney World 2 weeks ago.
I think we have time for like one more question from the audience. Okay, if not, I would like to thank you to our panelists for their insights and to our audience for your active engagement. Today we explore the convergence of technology, regulation, and strategy that is shaping the future of our industry. And as we look ahead to 2030, one thing is clear. Collaboration between humans and technology would be pivotal. So let's continue building this bridge together. Thank you for joining us. Oh, yes. Oh. Oh. Sí.
Well, so this is the conclusion of our first day. First of all, I wanted to congratulate our two moderators. You did an amazing job leading both sessions and our two main blocks of the day about geopolitics, technology, and the growing importance of adopting both in our processes and institutions. And just to finalize, I would like to ask you to summarize and give us the main highlights and insights you got from those blogs. Robert, you did an amazing job summarizing the state of the world in 20 minutes. Now, summarize your blog in a couple minutes for us, please.
Wonderful. Okay, well, thank you, everybody. I did my own little download here of the key takeaways from this morning. Here's the summary. The next 2 years are going to be a big tug of war. What does that mean? From the U.S. standpoint, we have a Trump agenda focused on tariffs, taxes, deregulation, deportation. What's the reality? Things are going to be slow. There's going to be a lot of people getting in the way. We're going to have executive orders, but at the end of the day, the political infrastructure is going to slow things down. Okay, so we know that. But then there's still the issue of deportations. There's still the issue of tariffs. And so that could have an impact on inflation. It could introduce more U.S. rate volatility, which is relevant for all of us here. From a global standpoint, what is going to be the Chinese and European response and potential retaliation? We could spend an hour talking about that. But what did the panel talk about at the end of the day? Yes, there's going to be an impact on trade. There's going to be an impact on global relations. There is going to be the potential for a competitive exchange rate depreciation in the Asia region with spillover effects potentially on commodities, which could impact this very region. And then we talked about demographics. We talked about it being a potential existential threat. And the #1 country out there is Russia. We also mentioned the conflicts in Iran, Israel, the Philippines. The bottom line here is for all of you to consider geopolitics in your toolkit of things to monitor very closely. And then under the surface, but also highly critical, the topic of sustainability. I mentioned some things about political constraints, but fiscal constraints also matter. Remember that governments coming out of COVID basically realized they just did not have enough money to go around and focus on their different priorities, but sustainability should be a priority. So, to summarize my summary, the next 2 years will tell us a lot about where we are going and how AI will continue to impact our lives. But beware of a deus ex machina that causes markets to unhinge and complicate everything. That's it.
And Antonio, same task, challenging. You had an heterogeneous panel, but same. Let's summarize your blog in a couple minutes.
Okay, thank you, Mario. Well, I was just recapitulating our previous conference and from what we came from. We came from with this thesis that we were approaching this exponential era in last year conference. Then, and we started like to show these general purpose technologies and like the first attempts of GPTs last time. In 1 year, we have seen a tremendous evolution of these and new applications, especially what has been evolving into domain-specific models, and now with this sort of look for agency of autonomy in these tools. As I will repeat that I feel that we have just seen the amoeba phase of the collaboration with this sort of new financial agents. From the other session from Rob, I have seen also the evolution and the convergence, and also there is a lot of potential regarding this other school of thought about predictive analytics. We have not just to focus on Gen AI. We have not seen all the potential that machine learning and predictive analytics has, and it will be a combination of both. And how all of this is changing the way that we are going to work, that we work. And the main message regarding the future of work definitely is redefine our relationship with machines. Also, this will have implications on the way we work and collaborate between humans in our teams. And the future of work will depend on how we adapt, and all will be about upskilling and reskilling. Thank you.
And the day is not over yet. Some ask about our dinner tonight. So we're having dinner at 7. It's in a different hotel. The venue is pretty similar to this one, so be aware of the air conditioning, and it's gonna be cold as well there. So your outfit is perfectly fine for dinner just as it is. And we have transport. It's pretty close. It's still here in the old city, but we don't need to walk. So we can meet in the lobby at 6:30 to take the transport to the hotel. Okay? And thanks a lot for your participation, and see you later.
And